So I can't hear anything. Can you all hear me?
Yeah.
We can hear you.
I think, oh, okay.
Yeah,
Yeah, we
I-
haven't called this one yet, Kathy, do it now.
Okay.
So we're, gonna call this meeting of the SIC, we still have 2 minutes though. So we don't have to call it to order yet. But, folks. Okay, 9 o'clock. We're gonna call this meeting of the SIC to order. If we can, take a roll call to establish a quorum, please.
Governor Michelle Lujan Grisham, Commissioner Stephanie Garcia Richards, Treasurer Laura Montoya,
Good morning, present.
DFA Secretary Wayne Probst. Present. Nick Tejas. Catherine Allen.
Present.
John Bingaman. Present. Kelly O'Donnell.
Present.
Alan Sanchez.
Present.
Bert Summer. Present. That's 8. We have a quorum.
Do I have a motion to approve today's agenda? Do I have a second? Second. Any objection to approval of the agenda? Hearing none, the agenda is approved. Do I have a motion to approve the August minutes?
Move.
Second. Okay. Any objection to approving the August minutes? Hearing none, the August minutes are approved. We'll move to agenda item 2A and hear from our state investor.
Thank you, Madam Chair and council members. As of this last Friday, we just passed $58 billion in assets under management. In looking at where this places us nationally, that means we just recently passed the Texas Teachers Permanent Fund in total size. Now, Texas has 2 different sovereign wealth funds. They're managed by 2 separate organizations. We just surpassed the largest one. We haven't surpassed those in total. But being managed by 2 separate organizations, as a sovereign wealth fund organization, we are now the 2nd largest in the country behind Alaska. And I think I'd like to take just a minute to bring you up to speed on the impact that we're having on New Mexico and the impacts that are projected. So this year, we're expecting to distribute over $2 billion back to the state for its budget. We are responsible through our distributions back to the state for funding about 27% of all K-12 education in the state. In addition, we're responsible for funding about 58% of all early childhood programming in the state. DFA put out a press release very recently where they quoted the state group of economists that are responsible for forecasting revenues. It's estimated by 2039, our distributions back to the state will surpass oil and gas as the most dominant source of funding for the state's general fund. That's pretty remarkable, and that's not in the distant future. That is 15 years. This organization is having incredible impact already. We have an amazing opportunity that lies before us. As we grow and our responsibilities expand, we're taking a look internally at how we can best meet that challenge. We're taking a look at how we can implement new processes, use up existing ones. People will always be our greatest asset here in this organization, but making sure that we have people in the right positions and the right structures in place is going to help make sure that they are the most effective and efficient. One thing that I'd like to bring to your attention is that Vince and I just recently created 2 new positions that didn't exist before in our agency, but we decided were best practices for organizations like ours to have after talking with a variety of peer organizations. The first is a Chief Investment Operations Officer, and this position is going to be responsible for taking a look at all of our internal investment operations, all of the ways in which the investment team interacts with other functions within the agency, interacts with the legal team, interacts with the accounting team, and see what we can do to streamline things, make sure that our processes are all best practices along the way, and come to Vince and me with recommendations for policy. Additionally, we've created a risk and performance officer to highlight the emphasis that we're placing on a variety of risks, not just volatility, but taking a look at other forms of risk, including industry risk, geographic risk, and as well, the emphasis that we're going to place on trying to improve our performance reporting moving forward, both to you as a council, but also through a soon-to-be revamped website so that we can be reporting much better to the public what we're doing, why, and what our successes are. We thought we might have to find people from outside the organization to fill those 2 roles, but luckily we have a great team of people, and we found 2 people within SIC already who we've promoted to into those positions. So Don Iglesias, we have promoted to the Chief Investment Operations Officer, and Nino Carpenito we have promoted to the Risk and Performance Officer. So I think in the coming months and then moving forward, you will hear more from them about their new roles, and I look forward to the additional efficiencies they'll bring to our office, as well as the additional reporting to all of you. Just want to highlight a couple of things on the agenda, just to make sure that there's not any confusion. We have 2 things on the agenda today related to the investment policy statement. You are going to be asked to vote on an investment policy statement that only has technical changes. Those technical changes reflect actions already taken by the council. There is nothing policy-oriented in that document. There are no technical changes that have not previously been seen. It is just to bring the investment policy statement up to date with all of the actions taken by the council. Separately, I'm going to be presenting some slides later about a proposed policy change to the investment policy statement, and we're keeping those as slides for now so that there's no confusion about which policy statement we're being asked to vote on. The policy statement has been discussed at both the Governance Committee and the Investment Committee. We received great feedback, and it will go back to both committees again in October. With that,
And we're voting on the investment plan.
and you're voting on the investment plan today. And with that, Madam Chair, I'm happy to answer any questions.
Council questions for the SIO? Really? I mean, I'd like to see like the job descriptions and stuff. I mean, I'm kind of curious. I'm happy about that direction myself, and obviously the choices. So yeah.
Absolutely, happy to do that.
Okay. We're hearing no further questions. We'll turn it over to Nick.
Well, thanks, Madam Chair. Well, as you saw, the Fed moved 50 basis points down on the Fed funds rate. We talked about that last month and had an expectation that they could do that. But the market didn't expect 50, but it's mainly because, I think anyway, historically when the Fed has moved down 50 basis points or cut rates by 50 basis points, something's been wrong. Almost every time they've been more aggressive like that, something has been wrong in the economy. Now, we are seeing the labor market, continue to soften up a little bit. Unemployment continues to rise very slowly and just by a small amount. And housing market definitely is slowing. So the 2 things that really have been pushing the economy here over the last year are softening up. But the market's still forecasting another 175 basis points over the next year. That's probably aggressive. I think the Fed came down with a big statement with 50, and we're going to stick there for a little bit. But we'll see. They're so data dependent. It just matters to them what the numbers are, and that's just about it. We're keeping our eye on the things they keep their eye on. Got to have an idea of what they may be doing. Stocks have really held in there, back to new highs. Across at least our stock markets. Foreign stock markets aren't quite back to new highs, but there's a little more economic trouble overseas. I still think we're relatively well positioned for kind of a little bit longer viewpoint. Nobody knows what's going to happen over the next year, but I do feel comfortable having a little extra cash and bonds around, just based on the valuations in the stock market, the concentration levels, among just a very few stocks right at the top, and some of the problems that we'll talk about when we get to the annual investment plan. Feel really comfortable with where we're sitting. I'd just add to John's comments, I'm just so pleased. We've been talking about an operations officer for a number of, 2 or 3 years probably. What that job would be, what it would entail. So I'm just so happy that's finally taking place. And then I'm very pleased that Nino has taken on a bigger role in our organization. So with that, Madam Chair, we'll stand for any questions or discussions you might have.
Questions from council? Turn it over to the investment committee chair.
Madam Chair, we had a good meeting last week. We did have a quorum. We did review and recommend all of the voting items, with the exception of 4C, where I had a potential conflict and needed to recuse myself due to an investment in a fund that I have that is affiliated with the manager. So we did not discuss or review 4C, American Securities Partners. All the other items we did. We also reviewed but did not vote on the investment policy changes.
We'll turn it over to our very first vote, 3B, changes to the investment policy statement.
Thank you, Madam Chair, committee members. One of the first items as your investment operations officer now is to make sure that we have a fully updated investment policy statement that reflects all of the changes that you have voted and approved on since the last time that you formally updated this policy. So to be clear, none of the changes that are discussed in this policy statement, which is going to start on page 24 of your diligent book, none of these changes are anything that is new or has not been approved by the council unless it is a legislative change, and we're simply codifying that in the statute. So I'll review really quickly the types of changes that are being discussed in here. For example, this incorporates all of the new funds that we have under management and that we've received since 2020, which was the last time this policy statement was formally updated. That's going to be changes on page 27 through 29 in adding all of those funds. This includes legislative changes to statute, so things like policy for how the tobacco permanent fund receives money. That was described in our statute and has been changed, was described in our policy. That's since changed. We've updated that language and updated some language around some of the other existing funds to incorporate changes that the legislature has made, say, for the tax stabilization reserve. This also includes all of the strategic asset allocations that you approved in last year, 2023, and the ones that you've approved for our new funds here in 2024, those are now codified in this updated policy change. As well as any structure study changes you made to say benchmarks, et cetera, that is now reflected in this document. And then there are some minor technical edits, language changes that just clarify what's going on. I do want to reiterate, none of these policy changes are things that you haven't already voted on. These have all been approved, with the exception of any minor technical edits, which really should be minor and clarifying in nature. If there is anything that you would like me to go over, I am fully prepared to go line by line to discuss any of these changes that are being made to make sure you're all comfortable with them and that they are either technical or previously approved. But But I know we have a full agenda today, so I want to offer to either open it up for just questions to see if you have any questions on the changes, or I am happy, if it is the will of the council, to go through each of these individually.
Any questions? We reviewed
Anything more? Do we have a,
Move we approve the changes proposed.
Second.
okay, we've got a motion and a second. Any objection to the motion on the table? We're gonna take a roll call vote on this. So we're, set to take a roll call vote on accepting the changes to our investment statement. Will you call the roll, please?
Commissioner Stephanie Garcia Richard,
Yes.
Treasurer Laura Montoya,
Yes.
CFA Secretary Wayne Props,
Yes.
Catherine Allen,
Sorry, yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
Stating affirmative, motion passes.
Thank you, Madam Chair.
So we're gonna go to agenda item 3C, the Blackstone presentation and update, and I'll turn it over to Treasurer Montoya.
Wonderful. Good morning, everyone. As Miss Kathleen McCarthy and Miss Alex Hill come up to the front, I wanted to give a little bit of background. If you all recall, a couple of months ago, we had quite a few meetings where we had public comment from Local Unite 11, and we had given staff a directive that we were going to hold off on investments with Blackstone because we had some concerns about the public perception, the press that was hitting us, the meetings that people were asking of us, and the concerns on the negotiations that they needed to work on. In the meantime, I met someone who was a fellow treasurer out of Chicago who now currently works for Blackstone. His name is Kurt Summers. And I met him when I went to the Milken conference, and we had a conversation. And I told him some of my concerns, and he got me connected with Miss Kathleen McCarthy. They ended up working diligently on this situation. And this is one of those success stories that I wanted to make sure that we also brought back to the SIC, especially because there was a beginning and then no one knew what the middle was. And then now this is hopefully a positive start to a new beginning. I wanted Kathleen and Alex to come before you today. Kathleen is the co-head of real estate, and Alex Hill is the head of the institutional business development for the Americas. Both of them are top leaders in Blackstone, and we'll give you a little bit more about Blackstone and also the relationship and the work that they've done to come to the table and do something that was meaningful for a lot of people that were being impacted by what was going on, and also showing their due diligence and their work being very thoughtful in the process. And so I'd like both of them to talk to you a little bit about Blackstone, what they've been doing, what partnership we've had in the past, what they've been working on since, and how this relationship can develop. And I'd also like them, if they wouldn't mind, to talk a little bit about how they have led the industry in DEI on their boards, as well as the Career Pathways program to help more than 5,000 people to work in their portfolio companies from colleges, community colleges, and training programs. And with that, I give it to Kathleen.
Thank you, Treasurer Montoya. Thanks to all of you for the opportunity to be here and to serve you and your beneficiaries. I am Kathleen McCarthy. I'm the global co-head of real estate at Blackstone. I've been at Blackstone since 2010, all of that time working alongside Alex, who has come before this group many times with different opportunities to invest together. We feel very grateful to be here. I think historically we only come in the context of looking for commitments to our funds. As has been said, this is really just an update on some of the investment performance we've been able to generate. I'd be happy to share just a little color on what we are seeing in the market, particularly in my case from the real estate perspective, although I can give some color from infrastructure as well, where you're all active with us, and then get to this broader point that we believe we deliver for you all as fiduciaries while simultaneously maintaining a great deal of responsibility and respect for our broad set of stakeholders, including workers and residents in our portfolios. I sent some materials in advance. I have no intention of going through every page in detail, but I just want to start by highlighting that we have invested $1 billion together. We are grateful to be entrusted with that capital. The most active areas have been in real estate and infrastructure. On the very left side, BREP is our global opportunistic series of real estate funds, and where we have generated a 1.5 times net MOIC for you, and the work continues in those strategies. You also invested into a specific fund that provides the real estate for lab research, life science, innovation. This is a specialized part of the office market, and we own one of really two premier lab companies in the space, and that's thanks in part to your capital in that. And then finally, infrastructure. We invest in hard assets, core infrastructure, and heavily inflation-linked, and we're grateful to have that partnership as well, where our team has generated a 16% net IRR for New Mexico. One of the ways, if you go to page 2, Blackstone as a whole, and this is just showing you the real estate portfolio, we really try to take a thematic approach to investing your capital. And that's because the way we believe that the way we can generate outperformance is not by giving you a little bit of everything, but rather concentrating you in the sectors of real estate that are benefiting from mega trends in how people are living and working and consuming and traveling as well. And so when you look at the portfolio, part of the reason we have continued to generate high teens net IRRs 30 years into doing this is really by selecting into asset classes like logistics, which is of course benefiting from e-commerce and the transformation in moving goods online and out of brick and mortar stores, residential, where we invest across the spectrum, everything from rent-regulated affordable housing all the way through market-rate apartments, and then in specialty subsectors where we bring both expertise and capital, hospitality, lab office, life science, as I mentioned, and increasingly as well in data centers, which of course are benefiting from the massive transformation towards an information-led economy, and data centers are the real estate really where that all happens. Our performance also reflects where we're not invested, and in particular, we have largely stayed out of the traditional office sector, which of course is experiencing the most headwinds today. And that's, again, a combination of using our insights and recognizing that office is facing a headwind long before we had COVID, long before we had a higher cost of capital, and we saw that as an opportunity to really pivot our investors into sectors that were doing better. I think the good news, if you go to page 3, and maybe building on what Vince was sharing about the economy as it relates to real estate, I think many of you know it's been a tough 2 years. The change in the cost of capital was punishing for many real estate owners. But we think we're hitting the bottom here. There's no one day where you know you struck it until you get well past that moment. But we describe it as bottoming, and it's not just us now. Green Street, which is really the most respected research analyst in the real estate space, have demonstrated 9 consecutive months of stable to increasing values across sectors. And so we take this as a moment to say, this is when we want to be most active on your behalf. Again, we don't necessarily, if you flip ahead 2 pages to 5, I haven't made my glasses here. Again, we don't try to pick like the very bottom moment, but we say, okay, when there's conditions coming into play where cost of capital is coming down, new supply is down sharply, and yet we still have opportunities to transact with folks who have liquidity pressure, maybe facing loan maturities. We use this as a moment to concentrate in the sector that, prices that reflect this kind of dislocated market. You're investing currently with us through BREP Europe 7. That's a Europe-focused opportunistic strategy. And there, just like everywhere in the world, you see us focused on logistics, on housing, and in particular student housing, and then data centers as well. In our infrastructure business, and we can flip maybe 2 pages ahead again to page 7, here, again, you see this thematic approach to investing, really 3 broad categories: digital infrastructure, energy transition, and transportation infrastructure. And also not just a portfolio limited to North America, but in Europe, and actually we're growing that activity as well. Again, consistent with these very, very same themes. And as I said at the beginning, contracted cash flows, inflation linked, and protecting you through a higher rate environment in particular today. Get to what I think, I would say that we are most proud of. If you go to page 8, as I said from the beginning, and Treasurer Montoya highlighted, we take very seriously our responsibilities to you, of course, but also to people in particular where we're providing their home as residential owners and managers, and then as to the employees of our companies. On page 6, we share, sorry, page 8, I think it is, I my boss with that. Getting old. Page 8, we highlight just, a few examples of our work in action. We own a portfolio of apartments that were built under the LIHTC program. This is a federal program that provides tax credits to ensure that folks generally making 60% or less or of area median income are able to be in high-quality housing that reflects roughly 25% or less of their income. We purchased this portfolio from an owner who was frankly trying to move as many of these properties as possible out of those rent restrictions as quickly as possible. We were able to buy it with lower cost capital that's perpetual in nature, and so we can make a commitment, as we have, to preserve the affordability in these communities for the long term. And we have just now started announcing the first of those recapitalizations to add 30 more years onto the affordability for these communities. In our portfolio, one of the things we always track is, how do residents feel about their experience? And what we see, because of our focus on the resident experience, because of our present management, capital investment into properties, responsiveness to their needs, we see a 20% increase in resident satisfaction rates when we buy apartments versus the experience of the residents under the prior owner. And then finally, really just as emblematic of our approach to how we support residents if hard times come, we took a position that was much stronger than anything required under law or recommended by any kind of government authority through the pandemic, and we conducted absolutely 0 evictions for non-payment of rent for 2 years in the pandemic. And again, this was obviously an extreme situation and an extreme and important step to support our residents, but I think again it's emblematic of how we operate every day. And how we operate is really guided, if you go to page 9, I won't take you through these in detail, but by a set of housing principles that are then backed up by very detailed manual of standards for excellence in residential operations that we enforce with all of our property managers, and we expect and hold ourselves accountable for. I'll skip ahead because I do want to highlight, I think, what really brought us to this room today and the conversation prompt here, which is also our commitment to workers. The workforce in our companies is really the bedrock of the performance we're able to generate for you. And what we know is that if we create terrific operating conditions and demonstrate over and over commitment to our workers, their experience, their careers, and importantly, if we can expand access to the jobs Blackstone and its portfolio companies create, we can produce stronger results. And so to date, for example, under our efforts to expand workforce opportunity, we've hired over 100,000 veterans and their spouses into our portfolio companies. We have a program called Career Pathways, which literally does what it sounds like it does. It's trying to offer folks who otherwise, because of the community they're in, the educational situation they've been in, otherwise might not have had access into career type jobs in companies like the ones we own. And so far, we've impacted 10,500 different people in giving them these opportunities. We've codified our approach and our commitment to all of our workers through a series of 10 workforce principles, which again, on the whole, are meant to represent the fair and attractive working conditions we are trying to create everywhere for folks who work in our companies. And I just conclude on the fact that with organized labor in particular, if you go to page 12, we have had a significant partnership and deep partnership for decades. I think, what we have always taken the view of is that we may come to commercial negotiations that can be difficult at times, but it is better to work together than against one another. And I think you see the fruits of this in the terrific and repeated acknowledgement of our exemplary treatment of workers and Unite Here in particular, which again, I think was highlighted in meetings here in the past, Unite Here in particular has made statements about us over and over again. We enjoy a tremendous partnership at the national level. In our infrastructure teams, you see our businesses focused on creating more and more pipeline of capital projects and opportunities to work with organized labor. We have $4 billion invested thus far and a $50 billion pipeline there. And if you look at the full picture at Blackstone, it's not only what we're doing at any one company level, but we have over 150 unions investing with us, which I think, again, is the ultimate signal of a really constructive and collaborative partnership, really reflecting, our values and how we operate on the ground and how we can deliver for them, just as we work to deliver for all of you. That I, of course, want to take any questions and happy to go back through any materials that I skipped over.
Congratulations. Looks like it's very well thought out.
Thank you.
Looks like your results are very positive.
Well, thank you. Our firm's existed since 1985 and our real estate group since 1991. And we have had an investment process that's really time-tested. And I think one of the things that's important to me as a leader, but I feel like it's important to our culture, is to just always be, investing in the opportunities that we see are the best, but also improving all of our operations and learning from everything we see and do at every step of the way. And so that experience does matter, not just in the investment results, but in how we operate as well.
So I wanted to share my perspective, because I did get very involved in chatting with the folks from Unite Here, and I think that was Local 11 that they're the ones who came here. So sort of what are their statements?
So the Local 11 folks that came, I believe, were from Southern California, and that conflict was really over two hotels that we own, which were a very small part of a much broader collective bargaining agreement. And as a result, again, Blackstone is very large, but in that particular situation, we were really not leading from the front. Many other managers and owners were. From the very beginning, though, as soon as those contracts had expired, we tried to take a very constructive approach and immediately and automatically delivered higher wages, higher benefits, and asked the Local 11 members in that jurisdiction, to please engage with us to resolve into a new contract. That all took a lot longer than we anticipated, but again, I don't think reflects the broader, Unite Here, how they feel about us, or how we ultimately always work through these negotiations. That was a very different set of circumstances, and I think we weren't necessarily always offered the opportunity to engage as we wished. And so, but I do think in the end, we reached a great outcome where, with higher wages, higher benefits, which we had again already put in place, and I think that they would tell you that that was a very fair and equitable resolution to what they were looking for.
So I guess, the beginning part of your presentation where you talk about your metrics and things, I think kind of puts a pinpoint on this dynamic that Blackstone is, a huge presence. They are a household name, really, and I would say kind of like the Goliath in the room. So it was, I just want to lift up those folks who were willing to come in person to take on this behemoth that they were employed by, and they felt like they didn't really have a lot of ability to have a say. And I'm grateful that you all, I know it took some time, but I'm grateful for your commitment to work through those issues and ensure that it doesn't matter if you are one of the leading firms in the nation, in the world. If you've got if your own house isn't clean, I mean, I just have to say, for me, I don't have a lot of financial experience, but reputational risk is a real thing as a person who is in the public, and so I really keyed into the conflict that was occurring there.
Yeah. Well, first I'd say I think our size brings with it great opportunity and great responsibility to be a leader in all aspects of what we do, including how we treat workers and then engage, should a situation of again, a contract negotiation like this arise. And we hold ourselves to an extraordinarily high standard, and again, recognize these are, human beings at the other side of a contract or at the other side, of a resident in need of help. And I think, how we conduct ourselves, I hope, creates a model for so many others. Folks like that who show up in your meetings, we are always engaged with ourselves directly and through our portfolio companies. We want to hear from them. We try to create every venue possible to do that. We recognize, though, they also can use forums like this to to have a voice, and we respect that as well. And so again, I do want to assure you that we take the reputational risk for ourselves, and then by extension how that impacts you all also very seriously. We're always trying to make sure that there's never a situation arises where you are worried about what we're doing on your behalf, or where you feel like you have been put in the crosshairs of something like that. And so we will do everything in our power to do that. And then should that happen, to again be very responsive to try to move through into a really productive solution, which I think we were able to do in this case, as we have been in so many cases. But I appreciate that very much, and I'm grateful that you continue to elevate that and highlight that for folks like me.
So I appreciate that statement, because I think what the frustration we had a little bit, and I'll speak for myself here, is that when we started to bring some of these items to the attention of, the SIC, our fellow members, the staff, it felt like the response was like, yeah, but, stuff like, look at their presence. And it's kind of like, I don't care. It doesn't matter to me. If we can have the best returns, historic returns, if there is still something that makes me uncomfortable about this investment, I'm going to continue to try and draw attention to it. So the fact that, those two things, that it shouldn't matter. I'm sorry, but they're not mutually. I personally believe they're not mutually exclusive. And every year at our annual meeting for our limited partners, I say that from the stage, which is, I think, not only can you deliver world-class returns and a world-class experience for your residents and for your workers, but I actually think, to the point Mr. Summer made, I think they reinforce one another. When you are managing well, when you have happy employees who feel motivated and well compensated to come to work, then that leads to better outcomes, actually. And I think, again, we hope that one of the things we're doing in the market is proving that out every day, that these two things are not kind of separate categories. They all relate to one another. And that's certainly how we operate. It is always, it is not great returns at the expense of something else or someone else. It's serving both. And you made another statement that I appreciated when you said, our workforce are directly responsible for the metrics that I just laid out. I appreciate that perspective. And I guess I just want to ask the risk person, will they be looking at things like this as well? Or can you kind of give me a sense of what I have talked to Nino, if Nino had already been in position, about my concerns around reputational risk, not necessarily other sorts of risks.
So, Madam Chair, obviously reputational risk is a form of risk that we have to be concerned about. There are governance risk issues that come up as well that we need to be concerned about. A large part of what Nino will be working on will be quantifiable risk, but we can't ignore reputational risk, governance risk issues that aren't quantifiable that we still need to pay attention to. There's not going to be a clearly defined way of how to handle that. We're going to have to handle each of those items on a case-by-case basis. Are not quantifiable, but that's something that we will absolutely continue taking a deeper.
I just think more and more, as there is a spotlight on investments that people make, the entire, perspective of these firms that we are investing in, I think we should come up with some kind of process of how to address that. Kelly, you've been so patient. Go for it.
Thank you, Madam Chair. And thank you, Ms. McCarthy. I heard you talk a little bit about preserving LIHTC property. What I'm more interested in is what you're doing with naturally occurring affordable housing. Obviously, it's a huge concern here in New Mexico and throughout the country. I know Blackstone is invested in a lot of build-to-rent communities. So I'd like you to talk about two things. Number one, what you are doing to preserve naturally occurring affordable housing vis-a-vis rent increases. And then number two, talk to me a little bit about why built to rent has become so attractive for investors relative to simply building single-family homes that people can afford to buy.
So, thank you very much for those two very good questions. I'd say, one, on naturally occurring affordable housing, I think, just a couple of things about how we operate. One is, if you're a resident in our community, you're in good standing, you're not, harming your neighbors, you are always offered an opportunity to renew your lease. I know there, sometimes you hear other managers taking different approaches, but we are always trying to do that. And I'd say one of the things we are very mindful of, when we're buying housing, whether it is a naturally occurring affordable or even a more expensive rental, for example, is just understanding what is the affordability for communities and for the people who live in that area. And what we see, I'd say, fairly consistently in what we own at the market rate housing, is that rents represent roughly kind of somewhere between 20 and 25% of someone's income, which is actually kind of at the lower side of the national average, which is an unfortunately high level, I will say. And so, and again, that is important to us for many reasons, including to make sure that the properties can stay leased, which is largely what we're trying to accomplish in our multifamily and our rental housing portfolios, is stay highly occupied. And that's really, that consistency of income is how we deliver for you. So I think, we're very mindful of that. That in some of the natural occurring affordable communities, like any communities, if people do choose to vacate, oftentimes we find that there's a lot of deferred maintenance. And we do try to address all of that to make sure the next renter has really a very high quality place to live. We're not talking about gold plating cabinets or anything like that, but making sure that things are, any one of us would be really pleased and proud to live in those communities. That will often reflect higher rents, but ultimately all of these rents are really a function of what is the supply of housing and comparable housing, and what are the rents. There's again not an ability for us to charge rents higher than market. I'd say on build to rent, and maybe just zooming out more broadly, I mean, affordability is a serious challenge in the United States and frankly around the world where we invest. And the problem is that as a nation, we have not kept up with the amount of supply needed to meet the population growth and household formation rates. And just to give you a sense, in the U.S. today, we're building as much single-family housing as, not we Blackstone, we as a country, same amount of housing as the country was building in 1960. And the population is 2 times the size. So what we want to be, and I think so many folks want to be, and now I think policymakers are aligning local all the way up to the federal level, is how do we create more housing? How do we catalyze more housing development? Build to rent, I think, is part of that solution. Given higher interest rates today, for sale housing is much more expensive on a monthly cost basis than it is for folks to rent the equivalent home or apartment. So that is part of what has made that an attractive asset class. It's just another opportunity for people to get into housing, in particular in better school districts, than they might be able to afford, given that interest rates have caused basically the monthly cost to be almost 2 times what it is for, in some markets, and 1.5 times the national average what it is to rent a home. So that has been attractive. We are frankly just beginning to be part of developing build to rent. What we have owned to date is already occurring rental housing, rental single family housing. But I look at this as just kind of one part of an ecosystem of creating a lot more housing, both for sale, single family, for rent, new market, for rent affordable and rent regulated. And again, I think one of the privileges we have, because we do manage capital across a risk spectrum as well, and also across tenure, as I mentioned, opportunistic, which is short hold, and then more perpetual capital, is to be able to serve all of that with being supportive of creating new housing. Thank you. Thank you.
Oh,
Sure.
So it's pretty clear, just looking obviously at the data on investor purchases of existing single-family homes throughout the country, but particularly in communities like Charlottesville and Atlanta, Albuquerque, that investors are purchasing large quantities of single-family homes and turning them into rentals. And to my mind, when I think about a supply constraint driving the price of housing up, the idea that smaller starter, entry-level homes are being removed from the market that's available to entry-level home buyers and turned into rentals for essentially what they would pay in a mortgage, that seems to me, as a non-real estate investor, like something that would have a pretty significant impact on the price of housing. And I'm wondering if your company has, number one, looked at that, and number two, thought of any policies that might help to dampen the impact that this, what some people might characterize as predatory investing in single-family homes in low-income neighborhoods, the impact that's having on the availability of housing for people who want to buy it.
Yeah, maybe we could go back to page 10, because this is something we study very carefully, and as you said, look at the data. Thank you. Go back to 10, I think it is.
Yeah.
Madam Chair, can you also share it on the screen, please?
And I go to this because it addresses these questions exactly.
Madam Treasurer, I think, this is a confidential presentation. I don't know.
It's okay.
Yeah.
Madam Chair, it is in the public.
Okay, so,
Okay.
can we do a screen share?
Thank you.
Tell us when you see it, Madam Treasurer. I guess we're not able to, I'm sorry.
Well, I'll just say aloud, if the folks on the line don't see it. So, there has been a lot of tension on institutional acquisitions of single-family housing. The reality, when you look at the data, is that only 0.5% of all single-family homes in America are owned by institutional owners, and that buying activity is down 90% over the last 2 years. So when you look at, again, back to what I was sharing about supply, the affordability challenge, the availability challenge for housing and single-family for sale housing in particular goes back to a deficit that has been building up since the global financial crisis, because we really never, as a country, and I think if we could be happy to report back on any particular market, but if you can look at just about every single market in the country, and you see that supply never caught back up with jobs and population growth. And so I'm sorry that I can't speak to Albuquerque specifically, but as a thriving place, I can imagine that this problem is exactly what we see in other places. And today, as a country, depending on which economist or which data scientist you talk to, there's a 4 to 5 million deficit of homes versus where we really should be to have a kind of a high functioning and affordable housing market. And so this is why I think, and we are grateful to see the attention to it from policymakers, which is how can both capital sources like yourselves, like what we pulled together thanks to relationships with so many investors like yourselves, and then how can policymakers help really pave the way, literally, to create a lot more housing to address this concern you have, which is absolutely fair as far as people want to be able to have home ownership, a home they can afford, particularly first-time homeowners, and it's really the lack of supply that is creating the problem for them.
Further questions? Well, we very much appreciate you all being here in person with us today. Thank you.
Thank you for the opportunity and for the partnership.
We are grateful, and I would say we are, you mentioned earlier, the behemoth of Blackstone. To us, we're just us, so anytime we can provide transparency or be helpful to you, we would love the opportunity to come back. This is very much something that we value, so thank you.
All right.
May I just make one more comment?
Oh, I'm sorry, Madam Treasurer.
Thanks. I thank you very much, Ms. Kathleen and Ms. Alex, for coming down to New Mexico. I wish I could have been there directly to meet with you, but I think overall for the council, I wanted to make sure that what we discussed prior to had an ending of showing that there was due diligence and there was a respectful contract that was done. I think there was 2 other groups added to the contract. They retroactively done the pay. They made sure that the amount of rooms that were cleaned each day by the individuals was not expanded because of the pay increase. There was a lot more deals that were done within the contract that I thought were respectful and thoughtful. As I learned more about what they've done, on the infrastructure fund, there's 90 local unions across the country that they work with, and they have a partnership with labor and the right to organize. When I looked at all of that, I bring this up not because I care one way or the other how you feel about a union. At the end of the day, as a fiduciary, we have a responsibility to make sure that the fund stays whole. To the chairwoman's perspective, perception and bad press, all of that matters. And at the end of it, it also matters what happens with the rate of return based on whatever we're doing within the fund. And so I thought that it was very responsible that Blackstone came to the table, had a thoughtful discussion, had a good contract come into place. And that's something that SIC members were able to negotiate or look at or review, and is not necessarily something that would be in the purview of staff. And so that was one of the things that I think is important in when we're looking at an overall structure and you are deciding who we're working with, something that Reverend Sharpton said one time for pension funds is you're giving a little bit of the money that you have, and yet sometimes it's used against you to take you out of your own communities. And so in a permanent fund, it's very different. The SIC is constitutionally and statutorily a group of people that are required to have the experience and investing knowledge and finance experience of at least 10 years. Because of that responsibility, I think we look at it holistically, not just on IRR, but on all the other factors that help contribute to the growth of the fund and the responsibility that we have to the taxpayers of New Mexico. So I want to thank Blackstone for coming down, and for others who have been working with us throughout this last course to be responsible investors. Thank you, Madam Chair.
Thank you. Thank you. Thank you. All right, we're going to turn it over to RVK, please, for our performance report.
Thank you, Madam Chair. Good morning, everyone. In your package, you should have the July preliminary performance summary. It is preliminary, so we'll be quite brief, given that it doesn't include some of the latest private marks. On the bottom right-hand side of page 86, you can see the trailing market performance. They are starting with the MTD, that's month to date, effectively reflecting July performance. And as you look down that column, I think you'll see some very favorable results, really, across all the different major asset categories. Positive returns, with the exception of the commodity index there at the bottom. Interestingly, the S&P 500, representing large cap, put up 1.2%. Not bad until you compare that to the Russell 2000, which has underperformed the large cap segment for basically all year, putting up 10%. And that was certainly a shift away from some of these largest names in the S&P 500 and Max 7 and some of the themes that we were talking about respectively for that. Some of that was driven by what happened on interest rates. You can see that on the top right-hand side, comparing the blue to the green line. That's just a change on a month-over-month basis in rates. You'll notice that rates came down really across the curve. The curve also flattened. And some of that indicative of likely the types of interest rates environments that we'll see going forward. That led to not just the fixed income market doing well, up about 2%. For the month of July, but as rates have moved lower throughout this quarter, fixed income is actually up just about 6% for a single quarter. So that's obviously quite a big number for a single quarter, just when you're considering fixed income. But it is indicative of rates moving really any duration-sensitive assets, so assets that have sensitivity to interest rates benefited as rates came down. And I think one of the things that you'll see because of that, when we get into the asset class composites in is that public fixed income actually outperform private, again, especially due to the duration profile of public having greater exposure. Cash is still maintaining the purchasing power. Obviously, there's still cash on hand as that cash continues to come in, and that gets deployed as quickly as it can. So it is maintaining purchasing power, still has a positive real yield, but of course, as Ms. mentioned, and everyone I think has been watching, Fed has started to lower the short end of the curve, and as that happens, that could bring, of course, some of these cash rates down a little bit. There's still a cushion, but I think we'll see some increasing pressures there as we start to move towards a more normalized yield curve. Stop here, happy to take any comments before Marsha gives you the portfolio highlights.
So I'm going to take you to page 88 of diligence. I think we're on the same page there. And again, this is for 1 month, your first month of your fiscal year, and you can see from the bottom of the page that we started off the fiscal year pretty well. You're up 1.38. Land grant was at 1.41. Severance a little below that at 1.3, but outperforming your policy minimum policy benchmarks in both cases. And across the board, for land grant, you see outperformance against the policy benchmark clear through 10-year period. The top half, or a little over half, is looking at the allocation, first of the land grant on the right-hand side, and the severance tax. Again, there is an interim target. You know why there's an interim target. You have a lot of money coming in. So it's hard to get that money deployed into your private investment. So there is an interim target. We show you both the interim and the long term, where there is an interim target. Right below that is for the severance tax. And again, there is cash, continues to be cash in both. The following three pages looks at the allocation for each of the individual funds. And again, where there is an interim target, we show both the interim and long-term target for each of those funds. I'm going to take you to page 92. And this, we're switching from fiscal year end to calendar year end. This is looking for 2024. The top is total funds. So it's broken out by the individual funds, but the top line is looking at the entire portfolio that you're responsible for. And just pointing out, this is the top line, the net cash inflows was $3.5 billion so far this year. And you've also had investment gains of under $2.8 billion. So that amount of money that you have is hard, again, to deploy into privates when, you can't do big chunks. You need to be diversified with your private. So again, that is, I guess that's a good problem to have, but it's harder for you to get to your target allocation. We showed each of the funds down below that, but I thought for time's sake, we would go to page 95 and look at the composite performance. At the top, we're showing again the performance of the land grant and severance tax. Looking at the individual composites, on the first page are the public, so we do have good numbers for them. U.S. equity outperforming its benchmark now through 3 years, so the changes to that portfolio over the last several years have helped. You can see outperformance against its benchmark. Non-U.S. longer terms outperformed. You can see for the month they actually trailed. If you're doing some work on that portfolio too. Public market fixed income, Nikki has talked about, it's all about duration. You do have a bit of a shorter bias on duration to your portfolio. So although the Bloomberg Ag was up 2.34, you were positive at 1.89 for the month, but underperforming that benchmark, again, having exposure to short duration was a bit of a headwind for you. And private, you can actually see that the private portfolio actually underperformed. Longer term, you can see the private portfolio has outperformed your public, but for this short period, it underperformed. Again, the benchmark, the underperformance against the benchmark, just reminding you that this portfolio, the private portfolio, is being restructured, and there was a benchmark change. So give it some time.
How much time, really? I mean, can you say?
Longer than I think what we've had.
Yeah, so it hasn't even been a year, right? Or
It's been
a year?
It's been over a year.
Over a year, okay.
But again, it's slow, they're private, you can't just reinvest, it's a bit of, takes a while, I don't know. More than money.
We do get questions about underperformance, and I mean, questions from, folks that.
There's no perfect benchmark, especially for any of your privates. I mean, here you're comparing against a public benchmark and adding 2, plus 2%. So the benchmark is, you can't invest in it. And I would give a little bit more time, and also, but I would focus on the private, if that's the question, as you compare to public fixed income, it's doing its job, it has outperformed public fixed income long term. And then we also show cash, as Matthias and Vince was referencing cash. Your 1-year number for cash was 5.34 for the month 24/1. We could see some changes there. On the following page, 96, most of these are private, and we don't have private values, only on a quarterly basis. The 2 that aren't would be, you do have some exposure for your financial real return, and also just pointing out the very small piece of the overall combined portfolio is the EPIs, 0.5% of the total portfolio, and again, that's benchmarked against cash. Underperformance there, that has another purpose. So with that, I wasn't going to go into any other detail because you don't have a full look at your portfolio because you don't have private markets.
I'm sure it's changed significantly in the last 45 days, is what I'm looking at.
Well,
These numbers are, I mean,
they're
you
old.
said $58 billion, that $58 billion can't be all contributions, it's gotta have been appreciation.
You headed it down, and on the equities, I think now you come back up, Matthias pointed out, on the ag, you're up over.
Both the SIC added another 4% since the end of that. So yeah, exactly
These
right.
numbers that we're looking at.
They're old.
They're old.
Fortunately, they moved in the right direction.
Oh, there for a while they
I
didn't.
understand that.
There for a while they didn't, but, yeah, back in.
All right, no more questions on the performance report. Thank you all very much. Thank you. We'll move now into our investment votes. So we're on agenda item 4, and first we're going to vote on our annual investment plan, and we'll turn it over to Mr.
Well, thank you very much, Madam Chair. I'm always so pleased to present this to you each year. But as I always say to you, the only thing annual about this is that we give it to you annually. But the plan indeed is for a 7 to 10 year period going forward. And we use that for a lot of different reasons. One, we think we can paint a pretty good picture of that sort of time frame. It's not so short that we get caught up with cyclical problems, but it's also not so long that only very long-term trends matter. And there's a few other reasons that we use that 7 to 10 year time frame. So that's what this plan is focused around, is that period of time, and we just happen to update it annually. It's become pretty popular. This is our 13th. I probably have a dozen or more emails in my email box saying, hey, you guys know we put this out in June, I want to read it. So about half the time we get it to you in June, and then we split the other half between August and September. It's happened to be September this year when we got it all together. As you know, the plan's broken down into 4 or 5 pieces. There's the macro picture, which I'll brief to you here this morning. There's a section on inflows, and we'll have Dawn brief that to you this morning. There's a section on portfolio analysis where we go through each of the portfolios and show statistics about those. There's a section on pacing, which is really important to your question earlier, Madam Chair. So Nino will brief you on that this morning. And then all of our asset class directors are available for that last section, which is asset class plans, so feel free to ask any questions that you like in any of those 5 sections. I do want to start, though, we're a little bit more cautious now than I think we maybe not ever, but more cautious now than we've been. We harbor some concerns about some big picture things that in the past have materially affected returns and financial markets. Right now, as we all know, our country, as well as many others, are deeply divided politically and socially. Historically, those periods have always resolved, just not very easily in terms of resolution. Wealth inequality and income inequality are near past peaks when we take a look at those. And again, we can't find times that reverse very smoothly either. And we think both of those things, at least in part, will be addressed over our next 7 to 10-year period. Periods like this come along about every 80 years or so. So if you look back 80 years from here, it was around the Second World War time. If you look 80 years before that, we were in the Civil War. Certainly not forecasting war or anything horrible, but these tougher periods come along on about that cycle, and we just happen to be at that part of the cycle that we've observed way back in history. Another concern we have are debt loads across the economy. Consumers, governments, and corporations are reaching and exceeding past records. That those have always been tough for countries to deal with when we get up to these high levels. And those debt levels aren't even considering the unfunded liabilities on the government, which, Social Security, Medicare, public pensions are all facing issues there. A lot of that's demographic driven, and we're just about to the maximum point of pain. The baby boom generation has just about retired. Yep, the last boomer was, depending on who you listen to, my favorite demographer says the last boomer was born in 1960. But Pew, which also does a great job on demographics, says the last boomer was born in 1964. So somewhere in that area. So most of the boomers are retired. The lead edge of the boomers are turning 80. And population of a group of people like that will really start to shrink once you get to 85, or north of 85. So we're just about the point of maximum pain in terms of retirements and Social Security and Medicaid. But it's going to last for a while. It'll take a while for the boomers to continue to move up. Their replacement generation, of course, is the millennials, a very big generation. They're still developing in terms of the generation. So we've got a little bit of a tough period with the debt, but inclusive of the unfunded liabilities. And then last of the concerns really is that, we've seen inflation come back. And part of our concern with the reignition of inflation here is that there's 2 ways that governments get out of excessive debt, or even a debt trap, where they're just simply trapped. One is to default. That tends to be smaller countries, certainly not countries with the reserve currency like we have, or even a large currency. But the other way is through inflation. That's how they relieve debts. Bigger countries like us with more important currencies. So we're a little bit concerned that we may be stuck with some inflation moving forward. Another thing that's we think could drive inflation over that next 7 to 10-year time frame is just simply de-globalization. So we went through a long period of time from the early 80s up until about COVID, where we were globalizing and really pushing things to the lowest cost producer and cost down. That's all reversing. Now, it's unlikely to reverse all the way back to where we were, but as we try to do more, or as each country tries to do more within their country and try to sort of friend-shore trade, we think that'll have pressures on inflation just about everywhere, including lastly, I guess, along with the deglobalization and the demographics, is we are expecting to have labor shortages, in particular here in the U.S. Just the boomers moving out of their positions and just not enough people filling positions as the economy continues to grow. We think we'll have labor shortages and increased pressures on wages. So it paints kind of a darker picture, but it's worth kind of understanding those things are happening. But there's things that we can do about it. And as we look back in history, we know that when tougher times come, and there's the potential for that over the next 7 to 10 years, really you want to enter a period like that with a very diversified portfolio. You want to be diversified away from particular asset classes, from particular market conditions, from particular economic conditions, and we've done that. So particularly from about 2018-19 to today, we have really diversified this portfolio, and you see it in your asset allocation mix every month, that we have quite a diversified portfolio. Portfolios used to be, 70% stocks and 30% bonds, or something similar. Today, we're 35% stocks. We've got quite a few bonds right now, but our long-term targets for bonds and land grants are only 6%. So we're quite diversified in all of our portfolios, as much as can be, to enter a period like this. The second thing, when you think you may be entering some tougher times, is to have strong liquidity. So as markets get volatile, and stocks bounce up and down, and we've seen historically 50% drops in the stock market's not out of the question. In fact, back in the 30s, it was an 80% drop. That strong liquidity, the ability to rebalance, and to buy risk assets when they are down, is really, really important. We are so fortunate, as we talk a lot about the inflows that we've had. It has really liquefied these portfolios. So we're in a very strong liquidity position today. We're in a very strong, have a very strong diversified portfolio today. So we're about as prepared as we can, at least in terms of the type of portfolio you have, if you felt like the waters were going to get a little bit rougher. The second thing is to recognize that tough periods in the economy and financial markets create enormous future opportunities. And there's a listing on page 2 of the report, page 119 in your book, of previous times. So if you take the Great Depression period, it was just economic chaos and 3 years of a bear market. But that was followed by a 14-year period where stocks gained 17% annually. Just a huge run in the stock market. Same thing in the 60s and 70s. There were 2 big drawdowns then. Both times, just tremendous double-digit long-run gains. In the dot-com bubble crash in 2000, 2002, that took stocks down 44%, but there was a 5-year period after that at 15.5%. And it just goes on that in these periods, when you do get rougher sledding, enormous opportunities emerge. And that's one of the reasons to have a diversified portfolio to protect as you go into that period, and then have the liquidity to rebalance as you come back out. So those are 2 things that we've been focusing on, being diversified. Also to understand that those periods very much can like great opportunity. One other strength I think we have is we've got a very experienced investment staff and also council members. So a number of council members managed through the COVID period, which was awful rough. We've got investors in the office that managed institutional investment portfolios through the great financial crisis of 2008 to 2009. Some in the office managed institutional portfolios through the dot-com bust in 2000, 2003. And even one, I'm not going to name him, but managed through the volatile 1987 to 1990. So lots of experience in the office in terms of managing through rougher periods of time in the markets. So with that, let me switch to the economic outlook very quickly. Still expecting low growth. It's just a function of demographics. Some economists one time said demographics are destiny. And the world's in a pretty tough demographic place. The U.S. is one of the better ones, and that's, you'll see one of the strategies we have listed here is to maintain strong exposure to the U.S. But we still have a growing population, with some reasonable growth. We're 350 million, 247 now by 2021. about 450, so that's above average growth of major economies in the world. So we're in better shape, or at least the U.S. is in better shape. Some countries are in awful shape. China's presently collapsing. South Korea's in the same boat. Germany's in the same boat. A lot of economies just really have tough demographics. So we think globally, and also here in the U.S., we will definitely see slower growth over the next 7 to 10-year period than we have over the last 7 to 10-year periods. We need to be prepared for that in our portfolios, that we're not depending on investments that depend upon the economy, growing at average or above average rates. Inflation we talked about, I think that's common. The offset to the inflation argument, though, and I plan to say this, but I think this is we've really had a slowdown in the M2 money supply. That's the most basic measure of how much money is in the economy. We've really had a slowdown in that. In fact, it actually. What is M2 money supply? It's just a total cash and deposit, short-term deposits that we have in the economy. So it's really important, and it actually took a dip right after COVID. It shot up and then took a dip, kind of correcting it. But what's more important is M2 normally grows at about 6%. Even if you think the economy, as we do, is going to grow slower than it has historically, you still would think 4%, 3.5%, 4%. Even if we were growing at 1.5%, real GDP. And we're flat on M2. And there's been 10 periods in the past where this has happened, and 9 periods had a pretty nasty recession afterwards, or depression. So that's a little bit of the offset to the inflation story. We still think we're facing higher rates of inflation, but I always keep it back in my mind to keep an eye on that M2 number and see if that's going to recover a little bit here. So we're going to comment on interest rates. We actually don't, while we actually see inflation being a little bit higher, we really don't see rates being a lot higher. There's just so much debt out there. Debtors just cannot take higher rates, much higher rates, without, the system kind of around. So we think there's some natural pressure on rates to stay a little bit lower. So we're really not expecting the, double-digit rates on the 10-year or something. We think there's a lot of natural pressure to keep interest rates a little bit lower. And I think that's it until we get to the broad strategy, which really is not much change from last year. We still think we turned a corner in 2022 from the investment environment that we had from the end of the 2008-09 financial crisis. We think that investment environment actually probably ended in 2000 or in 2020 with COVID. But definitely 2022 marked a change in things, particularly with inflation then picking up in 2023. I left some bullet points in there from last year. That was really popular. I got a lot of comments on that table that it was educational for folks, so I left that in there. But we still think that period, this next 7 to 10-year period, is just one slow growth, a little higher inflation, maybe some rougher waters, and some of the bigger picture issues that we have now starting to get resolved. So I think we're aligned with our asset allocation anyway, is aligned with all of those things to be resilient. Things get tougher, and for things not to get away from us if it doesn't get harder in that 7 to 10 period. And plenty of liquidity thanks to the inflows to handle things if things do get rougher for us. So that's sort of the macro picture and some of the plans we have. I guess there is a section still in there that we favor the U.S. We just think we have a lot of advantages here. We produce all the food that we eat and export. Beyond that, we can produce all the energy that we need. We've got 2 big oceans protecting our country from attack, at least traditional military attacks. But we have a growing population. It's above average, at least, among the rest of the developed world. There's just a lot of advantages here, including the dominant currency. So we pay a lot of attention to having good exposure to dollar-denominated this comment is the inflows, they're just game changing. And as Donna pointed out to you, we are expecting those inflows to meet or exceed our distributions, which means all of the investment earnings that the portfolio earns get to stay in the portfolio and continue to compound going forward. And that gives Milton Friedman that compound interest was the eighth wonder of the world. So that's happening in all of our portfolios thanks to him. So let's bring up Don so you can talk
So
about.
then, while Don comes up, do you ever look at pressures, from climate change and just in terms of, you know, increased climate refugees possibly, just changing folks migrating throughout different regions of the U.S., but then also, energy, you know, diversification, moving to different energy sources, that kind of thing?
Yeah. It's hard to quantify the effects of climate change. You know, we read a ton of stuff on it, and a lot of it's conflicting, but it seems to be hard to quantify what can happen. There's a few trends that, that are there. One side of it is there's change going on. The other side is humans are adaptable, so it's really hard. It's really hard to quantify. On the energy, sure. We think that could partly feed the inflation, just making that transition. There's good evidence that can and maybe has even occurred. I think it's necessary, to deal with that. But yeah, that comes into our equation.
Madam Chair, I'm going to be starting on page 124 of the annual investment plan or of your diligence book. This is our inflows analysis, and it's been pretty astounding. Over the last 2 years alone, if we're just looking at calendar years 22 and 23, we received $14 billion in just 2 years, with another $7 billion expected to come in over the course of 2024. So of that, we've actually already received in the door about $5.5 billion, and we are still currently on track for our roughly $7 billion inflow estimate. The remainder to come in will be the monthly distributions from the state land office, as well as an expected inflow for the early childhood fund that will come in around the time of the audit, so around December. That will be the excess amount of school tax that was collected for this year, which will bring roughly another $650 million or so into the early childhood fund, which has already grown pretty significantly. And as Vince was saying, and as Marcia mentioned, looking at those distributions, at least in the short term, or those contributions to our funds, on net, once we look at all the distributions that we're making, for this year, that's still about $4.8 billion in total that will have come in, exceeding the amount of total distributions that we've had. So our net inflow is still very cash positive for just looking at contributions into the fund from oil and gas revenues, et cetera, versus our distributions to our beneficiaries. I want to highlight for you on this chart on page 1, this is very similar to the outlook that you've seen, and at the moment, there's still no significant change. We track these markets, the energy markets, very closely. We run a variety of scenario analyses. We look at what our state is producing from the Consensus Revenue Group. We look at Rystad Energy, Oxford Economics, IEA. We look at a handful of sources, and right now, our current baseline outlook is the same as what we presented to you earlier this year, relatively minor changes. So we're still looking at, over the course of, through likely the end of this decade in our base case scenario, still receiving over $4 billion into, across all of our funds as an inflow. And when you look at that still historically, that's still a lot of cash that we are still getting used to deploying through. So those strong inflows are still expected to continue, unless, of course, there is some substantial shift in the energy market, which we do track closely, and we'll update and make sure that you are aware of any changes that occur into that outlook. But so far, we're still on track. I want to move forward and note for you the table on page 127. This is a new table we've added into the annual investment plan that really helps to identify where these sources of inflows are coming. So these are all of the funds that we're managing. And there's a quick reference table for you to see over the last 5 years and then the expectation for this year, where exactly those funds are coming in. And so you can see, in 2022, $8 billion total received, 2023, $6 billion, and we're looking at another $7 this year. So that's an astronomical amount of revenue to be receiving into the funds in such a short period of time. The next thing I want to highlight for you is on page 128. This is our portfolio analysis. So in these sections, we go through each and every one of these funds, looking at expected NAV growth and expected distribution growth, because the primary reason that we do what we do is distributions to our beneficiaries. So we do include outlooks for our distributions, at least under our base case scenarios, using our current 2024 capital market assumptions for each fund to give an overview of those. So for example, turning to the next page on page 129, this is the outlook for the Land Grant Permanent Fund. We have a expected NAV growth and the portfolio value estimates. So looking at our base case from our current NAV, this fund under that base case scenario is likely to grow alone to $60 billion, just the Land Grant Permanent Fund over the next 10 years. And then we look at that difference, plus or minus 50% contributions. And part of the reason that we look at it this way in the annual investment plan is to highlight the importance of the inflows into that growth outlook. And so you can see there's a relatively wide range in that 10-year outlook on how big this fund could grow. 48 billion on the low end, 73 billion on the high end, depending on the size of those inflows. But in either case, that's still a very significant amount of growth, and that highlights that even in our low case scenarios, when we look at the inflows coming in the door, they're still so much larger than what we've received historically, that growth of the fund is expected to grow pretty significantly just by inflows alone. And then we also look at distribution estimates, and you'll notice in our base case that over the course of the next 10 years, we expect distributions from the Land Grant Permanent Fund to more than double to benefit schools and to benefit early childhood education. And I want to go into the Severance Tax Permanent Fund. If we look at that on page 131, we have similar charts looking at the Severance Tax Fund. And one thing you might notice flipping from one page to the next is that the slopes of the growth of these funds are very different. And that is because the Severance Tax Fund is receiving a wealth of new inflows that it has never received before, which is really changing the growth trajectory of that fund in a very different way than it has grown in the past. And most of that is due to legislative efforts to put additional funds into this. The largest one, the most impactful, being Senate Bill 26, which will send excess oil and gas school tax and federal royalty revenue into this fund, again, not impacting the above 5-year averages that go to the early childhood fund. That mechanism is still in place. But the sending of these revenues is really going to change the growth trajectory, and that's in addition to, or in combination with, the legislative deposits that were recently made, $475 million deposited last year, along with minimums from the Severance Tax Bonding Fund that really codified debt savings from cash funding capital outlay. And the legislature said we want to make sure that those debt savings are directed to be deposited into this fund. So there's been a lot of focus from the legislature on growing these distributions to the general fund to really help offset the expected future declines of oil and gas revenues into the general fund. And I would like to point out that the Legislative Finance Committee, along with other members of the Consensus Revenue Group, recently presented, I think last week, to the Legislative Finance Committee on their long-term revenue outlook, and there was significant attention in that presentation on the impact of the Severance Tax Permanent Fund and how crucial it will be in the future planning for offsetting those oil and gas revenues. So we have a very important part to play in the long-term budget stability of state government. And ultimately, once we look at that three-legged pillar of what supports our state budget now, gross receipts tax, personal income tax, and oil and gas revenue being the biggest contributions today, by FY50, that pillar is expected to shift entirely in this consensus revenue outlook, where our three big pillars will be gross receipts tax, personal income tax, and permanent fund distributions. And that really highlights through this mechanism as well as the land grant distributions just how important these permanent funds are to the long-term stability of the state. Keeping on that tone, I also want to highlight on page 133, the early childhood education and care fund and the growth of that fund. You've heard this theme before when we've discussed it. Very significant growth in the near term as those distributions or contributions into that fund have been enormous over the last couple of years because of that mechanism that says anything over the 5-year average for school tax and federal royalties will go into this fund. And that chart that I highlighted for you, we don't have to flip back to it on the page, but the chart that I had highlighted for you on page 127 really shows those contributions, $3 billion in 2022, $2 billion in 2023, and a total expected by the end of this year we'll have received another $3 billion in 2024. So this fund has grown significantly, and we expect to end the year, if all things go well, and markets perform as we expect, we should end the year around $9 billion for the Early Childhood Fund, which is just incredible growth from the $300 million it started at in its first appropriation in 2020. And so this mechanism is doing exactly what it was designed to do, capture those oil and gas windfalls and deposit them for the betterment of the long-term betterment of the state for early childhood education. And the other sort of fun fact to leave you with before I turn this over to Nino is for early childhood education. We put this together for the Education Study Committee and a few other legislative committees looking at the total contribution of funds that we manage into the early childhood budget. And when you combine the distributions from the Early Childhood Trust Fund and the new distributions from the Land Grant Permanent Fund, the amount that early childhood gets of the additional 1.25%, our permanent fund distributions in FY25 now account for over 58% of the entire early childhood budget. So just wanted to highlight for you, again, the importance of these funds for state budget overall, for early childhood education, and the amazing contributions that these funds are making. And with that, I will turn it over to Nino for pacing, unless there are any questions by the...
I'll just say, if you want to make it even more historic, we would raise the royalty rate and capture a little bit.
Thank you, Don. So I'll be focusing my comments largely on the aggregate portfolio. So we'll be focused on page 141. Things are largely, as Don described, a continuation of what we've seen from previous years, with the inflows driving commitment activity across the private asset classes. One theme that we noticed the last couple of years that has continued is that funds are taking longer to invest. And so the period from when we actually, approve a commitment, when they actually begin to start investing, that length of time is starting to get longer and longer. And part of the reason is it's a very difficult fundraising environment. Most institutional investors will fund capital calls through distributions. Distributions have largely dried up, and they don't have, the advantages like as Vince described of having these large inflows coming in every month. So managers are having to stay in market longer. They're offering more incentives than they have previously, to which we're making full advantage. So that length of time, so things are a little longer duration, things are getting stretched out just a little bit more than they have historically. To account for that, we've made some changes to our inputs into the pacing model. And then last year, we added an additional year in our time frame, which is essentially the forward period where we're looking to achieve these target allocations. Based on what I've seen so far this year, we're probably going to be needing to do that again this year. I think that's the prudent thing for us to be doing. If we take a look at, so as you can see here, the chart on the top left, we have our commitments, and so you can see, you know, much elevated activity over what's been done previously. And in fact, these levels are so high relative to what they were in the past, it's almost as if we're starting a portfolio from scratch, because we're experiencing the same types of issues that new investors face, where you have an excess amount of cash, right? So you have this cash drag. The other thing, and we'll get into this in a moment here when we talk about the cumulative net cash flows, is you're in the J curve, right? And one of the things that we've seen is, you know, a portfolio that, you know, by most accounts was mature has now become much younger, and we're seeing kind of that double dip in the J curve. And that's something that is starting to impact performance, and I think going forward it's going to impact it to a larger degree. However, I think that, you know, rather than being a reflection of performance or skill or anything like that, it's largely just a function of kind of where we are within kind of the J curve and within, you know, these respective funds kind of life cycle. And so despite contributions being lower than expected, and then, as I said, you know, that's being partially offset by lower distributions, you know, with the level of pacing, the contributions just, they overwhelm, you know, the distribution. And so we end up with, if you look at the chart on the top right, where we're looking at net cash flows. And so you can just see, I mean, net cash flows, you know, in the current year and then going forward, where we have, you know, just significant net cash outflows, which for us, you know, is helping to absorb, you know, the excess cash that's accumulated and that continues to accumulate. Last year was a bit of an aberration because, and that's largely because on the private debt side, we did a handful of hedge fund redemption, and so we received a lot of redemption proceeds last year, and so that's pretty much what drove last year. Otherwise, you would have seen a similar result. And then the chart on the bottom left here, so here we're looking at cumulative net cash flows, and so this illustrates the classic J curve. So you can see here where, you know, we were starting to make that trend up to break even. However, you know, with the increased level of activity, that's just causing us to go back down and actually deepen. And then you can see the chart on the right here, you know, depicts our projected net asset value. And just to kind of, you know, to put this a little bit into context, you know, the current NAV of our private asset classes is about $20 billion. So for us to achieve the target allocation in 5 years and probably, you know, 6 years, that NAV is going to need to be about $40 billion. And so, yes, it's quite striking. I mean, the numbers are just so much larger. And in order for us to hit that net asset value and the resulting target allocation, in terms of commitments, you know, we're going to have to have between $4 and $5 billion of commitments every year. In terms of net cash flow, you know, to absorb the excess liquidity that we have, we're going to be looking at net cash outflows of, you know, $2 to $3 billion a year. And what I'd like to do is, I commented a little bit earlier about, you know, funds are taking longer to invest. So when I reported to you last year, we had about, and I would say a carryover or a backlog of over $3 billion. And so what that meant was we had prior year commitments that had yet to begin investing.
right now, and this is current, that backlog is 1.4 billion. So we've largely cleared the majority of it, and then, of course, the commitments we make this year, we would imagine that a large part would probably spill over to next year. So the likelihood is we're going to have, kind of going forward, we're going to have, this backlog or carry forward of probably, $3 to $4 billion. And so at some point, I think the market environment is going to be more conducive to, putting capital to work, to deploying capital, and we'll start to see that, diminish over time, as, managers put more, capital to work. And then I also wanted to provide, an update on, our year-to-date and kind of where we stand versus, what our plan was. And the reason, this is important is, with our models, we're constantly updating them to reflect, current market conditions and, so that, the models are responsive and that it takes that into account when you're formulating your plan kind of going forward. And so what happens this year, when we get to the end of the year and, we update all of our data and then we roll forward our plans, is going to have, an impact. And so I wanted to go over that. So from a commitment basis, we were looking to do about $3.8 billion in commitments in 2024. We've actually overcommitted to this point, and that this includes the proposed commitment from the private equity program that we'll be presenting a little bit later in the meeting. So we've actually done $4.4 billion thus far to date, and that's been driven primarily by private debt and private equity. Our asset class teams are finding an abundance of good opportunities there. On a net cash flow basis, our expectation was about $3 billion in net cash outflows. And as I described, that we're going to need to average about $2 to $3 billion in net cash outflows a year to soak up, all that excess liquidity that we have and that we're projected to have. Year to date, we have net cash outflows of about $1.4 billion. I think we may end the year at about $2 billion in net cash outflows. Certainly, we would like that number to be bigger, but certainly making a dent on our excess cash. And then from a net asset value perspective, so we would expect to end the year at about $19 billion across the private asset classes. Right now, we're at about 15.5. Part of that is that contributions have been lower than what we expected. And then I think partly as well is I think that performance kind of across the private asset classes has been more modest. And a lot of that is due to the fact that we are, back into the J curve. So that was all that I had. The one thing I just want to kind of leave you with before we go to questions is, think of pacing as a guide, really. And essentially, a few years ago, we took this in-house for a couple of reasons. We wanted to have a consistent methodology and treatment across our private asset classes, but also to afford ourselves maximum flexibility. And so really what we're trying to do is we want our asset class teams to be opportunistic, to take advantage of current market conditions, and really the best managers when they're in market. So there are going to be years where we're going to commit more. There's going to be years where we're going to commit less. But at the end of each year, we're going to take into account what has happened and then adjust our plan going forward. And this is something that, unlike public markets, the private market, the best way to add value is through manager selection. And you take a look at the dispersion of returns within any of the asset classes. And actually I can quantify this a bit. So one of the exercises that we did, and we'll have more to talk about this when we dig into performance, but we took a look at the Burgess Manager universe, and arguably that's probably the broadest and the deepest private market universe that exists. And so we took a look over, the vintage years that we've invested, and we said, okay, well, let's take a look at, the interquartile range. So this is basically the difference between 75th and the 25th percentile. So you throw out the outliers and you focus on the middle 50%. And so what was, the average vintage year dispersion? And so the range, the minimum range was about 700 basis points for private debt. And then, the top end of that range for private equity was 1,600 basis points. And so, it's important that we put money to work, but it's just as important that we put it to work with the right people. And with that, I'll open it up to any questions.
Chair, congratulations on your promotion, both of you.
Thank you.
It sounds to me like you've got a lot more info and do you have the staffing to deal with this problem? It sounds to me like that's a problem.
Yeah, Madam Chair, Member Summers, we got 5 new positions this year, and we're looking for more. If I were just to put out a number, we could double on the investment team, everybody busy.
What I'm hearing is that's significant.
Yeah, I can add a little bit of context here. So I've been with State Investment Council for over 16 years, and the investment staff is substantially similar in size to what we had then. And when I joined, we were $15 billion. Certainly that human capital is a big part of it. I think the other part of it as well is technology. And that's something that that we've been looking at as well.
Are we ready to vote on this investment plan? Are we ready with a motion? Do people feel comfortable with that? Are there further questions folks have? Kevin, do you have a motion?
Yeah, Madam Chair, based on the recommendation of the Council Investment Committee, SIC staff, and General Fiduciary Oversight from RVK, I move that the State Investment Council approve the fiscal year 2025 annual investment plan as presented to and discussed by the Council today.
All right, we've got a proper motion and a second by Member Summer. Any discussion on the motion before us? We are going to take a roll call vote on adoption of the investment plan. Please, Brett.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya. CFA Secretary Wayne Probst.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Sommer.
Yes.
7 in the affirmative, motion passes.
Well, for your work. All right, next we have a structure study. If we can invite Director Sable to the table. Real estate. Whenever you're ready, sir.
Thank you, Madam Chair, and welcome to the 2024 Real Estate Structure Study. I have a little bit of good news and bad news. We'll start with the bad news, and that is that there are 40 slides in the deck. The good news is there are only 2 items requiring a vote, and those are a small fraction of the slides. And so we'll hope to dispense with this on a reasonably hasty time frame. The appendix material is about 20 pages long, and I've personally found a bunch of that particularly interesting. I would commend that for your future review at your leisure. And before I dive in, I want to mention that Rob and Malcolm Blake are joining me from Townsend. I want to acknowledge Malcolm's hard work on the structure study, and also my new analyst, Juan Treviso, who was a key participant in the preparation of materials. If we turn to page 159, it's a brief overview of the presentation. We're just going to focus on bullet points 1 and 4 for the course of this presentation. Page 160, there are 2 key items for which we'll seek approval that will require changes to the investment policy statement. Those are amending the ranges of permissible investments, so the mix between core and non-core, and then a change to amend the benchmark to reflect that change in mix over time. Beyond that, most of the items are essentially just plain vanilla implementation details that I think will have folks review on their own. Happy to answer any questions related to that content in the presentation. Working in reverse order from the bullet points on that slide, there are 2 items that we want to raise the profile on a bit. First is we've not made much use of public equity outside of the public equity portfolio, or REITs outside of the public equity portfolio. Slide 172 presents a handful of potential use cases, so I just want to raise the profile of that issue here and let everyone know that we're considering other options for their use over time. In any event, these would typically be implemented through a separate account structure, and each of those would be brought back separately going forward, so there's not an action item related to that today. And then, given some of the points Neo made about J-curve and just generally our scale, we do have the opportunity to benefit by improved access to co-investments. Slide 168 demonstrates it's possible to capture as much as 18% of the capital deployed in one of these co-investment vehicles, so substantial savings available through that mechanism. The slide also points out that there are other costs and benefits associated with doing those structures, and we can deal with any questions that people may have related to those as we proceed. Moving up the page, most of the key elements of the IPS remain intact, so the focus on geographic diversification, sector concentrations, and the list of authorized investments would remain unchanged. I think with that, I'll hand over to Rob real briefly. We'll move to page 163, and he'll address some of the role of real estate in the focus of the study as well.
Okay, good. Good morning, everybody. We're glad to be here, and again, acknowledging Malcolm, who's been here once before. I just want to reintroduce him to the group, because he had a lot of participation in the product here. What we're really talking about today is a shift in the risk profile of your real estate program that's consistent with all the growth that we've just talked about, the growth in terms of income and cash flows and liquidity and the size of the program. And you're in a good spot right now where you are in a position to take advantage of that. And looking back at historically institutional investors such as yourself, you know, when we got into real estate, there were a lot of different reasons why investors invest in real estate. The primary ones, institutional investors like the cash flow, they like the income, they like the diversification benefit, they like the fact that real estate tends to appreciate in value consistent with inflation over the long run, so there's a realistic inflation hedge there. And then the fact that you're investing in hard assets, so there's always some intrinsic value there, so there's a feeling that real estate and other real assets where you're investing in hard assets, there's a downside protection, capital preservation that we call it. And what we're talking about today is really shifting the priority of the objectives of the program not really abandoning anything and not giving up anything in a significant way, but shifting the priority a little bit consistent with your growth and your liquidity profile. And so that's what's on page 163. If we look at your investment policy statement as it is set forth today with respect to real estate, you're very similar, and the statements there are very similar to a lot of our pension fund clients that use real estate to pay ongoing pension benefits. And so your IPS, your investment policy statement, talks about, generating stable income, capital preservation, diversifying with respect to other asset classes, et cetera. And what we're really doing is shifting the emphasis more towards total return and growth in wealth and growth in value over time. And you have the ability to take advantage of that today. And it's a good opportunity it's a unique opportunity really across institutional investors in the U.S. So as you have this long trajectory of the next 10 years of high levels of cash inflow, you can take some of that money, lock it up in a little bit higher risk, higher return strategies that are expected to generate higher returns over the long run. And there are really two specific changes as Keith outlined, and I'll hand it back over to Keith to highlight the first of those, which is the shift from core investment to non-core investment. And just a note that there is a definition, if you will, on slide 182. We don't have to go there now, but if you want to keep a finger on that page, you can understand the difference between the core real estate, or at least it defines core real estate versus non-core real estate.
So if we turn to page 164, this slide illustrates the first key voting item that we're proposing. Because we believe that it's appropriate to seek out incremental, well-compensated risk in pursuit of higher returns in the portfolio, we're suggesting that the target be moved from 60% core and 40% non-core to the reverse of that, so 40% core and 60% non-core. On the box on the top left-hand corner of that slide, you can see what the current IPS ranges are, and you can see that we could actually implement that 60-40 mix in the bounds of the current IPS. So specifically, the voting item is designed to provide a margin of safety around that target, and the recommended ranges are in the right-hand column of that top left-hand table. I think I'll just leave it there, Rob, and hand it back to you for the rationale behind why we picked 60-40.
Yeah, and the next couple of pages really talk about expected return and the risk that you're taking. And what we're trying to present here in the next few pages is this is a shift in risk profile, but it's not a substantial change in the risk of your program. Obviously the object is to generate higher returns over the long run. So historically, when investors like you invested in real estate, it was in more core real estate, very stabilized, income-oriented properties. And over time, the market evolved, and you had available to you a lot of other types of investing that we refer to as core plus and value add and opportunistic. And so the market diversified, and that allows us to help structure a program to better fit each investor's individual situation or individual needs. And we're able to do some portfolio modeling around these various categories of core plus, value add, and opportunistic. And that's what's presented on page 165 of your book. And the two takeaways from this page are, first, you already have a very well-balanced portfolio. We don't see an opportunity to, increase the return by rebalancing a little bit with where you are today, because maybe you're taking more risk than you need to achieve the returns that you're getting, or you're getting the return and you're leaving risk on the table, if you will. What we would say is you have a very efficient portfolio mix today, and the only way to really increase the return profile of your program is to shift up the return curve, and that's what's presented on page 165. This is a traditional consultant mean variance portfolio mix or portfolio optimizer analysis, and we look at, we want to balance out the risk you're taking with the return that you're achieving. And what we're trying to do is move it up the scale a little bit, move it up the curve a little bit. That'll generate about 40 to 60 basis points of extra return over a long period of time. We usually refer to that as either 10 years plus or a full market cycle in real estate. And that will, all of our modeling, our expected returns from the various sectors is laid out on page 165, and that's what's presented there.
If we go over to page 166, this slide highlights that really it's a pretty modest change in the risk profile of the portfolio, all in all. The data behind this is Townsend's proprietary benchmarks for non-core, and those were compared to Odyssey. A couple of things that I'd like to highlight on here. One is that the mean return of these 5-year rolling returns was expected to increase by about 40 basis points, and that's what shows up in the history. What you're seeing on this chart is two return distributions, one laid over the top of the other. The orange curve is the mix of 5-year rolling returns that would have been experienced historically had someone invested in the current mix, but in the Odyssey benchmark and in the non-core Townsend benchmarks. The blue curve demonstrates the shift to the right, so we're taking on some incremental risk by picking up a slight increment of return, and you can see by the light blue on the right-hand side of the chart, that curve has indeed shifted to the right. What's a little bit difficult to see on the chart is on the far left-hand side, there's also a small light blue amount. What I want to remind everybody is that this is a portfolio mix that will be riskier than what we've seen in the past. If we see historical drawdowns that are worse than anything that we've seen in the historical rolling 5-year period, we would expect to underperform what this current mix is during that circumstance. One of the key considerations when we're making a change, recommending a change in portfolio mix is making sure that we're benchmarking that whole process correctly. And so we spent a significant amount of time working on the benchmark related issue. Our goal was to find a benchmark that appropriately compensates SIC for the risks inherent in the portfolio construction. And we were focused on establishing a benchmark that would be most relevant by the time we get to the end of the 2028 structure study period. In terms of looking at benchmarks, we considered a whole range of alternative specifications, including beta plus a premium, so a capital markets model for that premium, and also looked at just straight out beta multipliers. So if the Odyssey went up 100 basis points, then maybe non-core should be up 1.2 on a fixed rate basis. We found that none of those were particularly intuitive specifications, and so ultimately we converged on the same standard that most of the market seems to be using, and that is an Odyssey plus a premium construct. We looked at rolling 5-year windows of returns in terms of the spread non-core to core, and we found that average spread was about 170 basis points. And so we just did the basic math around mixes of 40% non-core, 50% non-core, and 60% non-core to capture the transition of the portfolio over time with this repositioning. That would imply 60, 85, and 102 basis points as appropriate spreads on a portfolio weighted average basis. So in the 102 basis point spread number, that would be 60% times the 170 basis points plus no premium for the 40% that's on core.
And do you have like the risk changes too for those three? Or is that?
The mean variance analysis that Rob presented a couple of pages ago captures the risk difference. And so what I want to do is just express the idea that our portfolio mix is changing over time. And because it's changing over time, premium that should be expected would also want to change over time. In the structure study, we want to be able to establish a fixed benchmark and not have to look at kind of formulaic updates through that window. And so we've opted to target a benchmark that would be appropriate at the tail end of the window. The implication on that is it will be relatively aggressive for what we would expect to be able to do on the more recent periods and is more reflective of kind of a run rate status quo from 28 of the issues that will, also complicate this, somewhat is the idea that we had a significant J-curve, and Nina kind of described what's going on with that, earlier. We estimated that the J-curve impact on performance, in the current time frame would be on the order of 45 basis points, and, as the portfolio, matures toward the tail end of this structure study period, we'd expect the impact to be on the order of 25 basis points. And so the recommendation for 75 is, the benchmark comes from the weighted average math at 100, less an expectation of 25 basis points of J-curve, related drag. And it's a bunch of reasonably complicated math to get to this place, and we wanted to do a sanity check on that. And so we reached out to RBK, and they were very helpful in putting together a survey of the benchmarks that other institutional investors like ourselves are using. Many of them use a NCREIF Odyssey-based benchmark. The benchmark that we're recommending will be more aggressive than at least 2/3 of those other funds. And so we think we're in the right ballpark, and this will certainly be a much more appropriate benchmark than perhaps we've had in earlier days. I think I'll leave that there. Rob, you had mentioned wanting to say something else about the other drags that are potentially an issue.
Yeah, and if you think about real estate, it's two extremes, if you will, in terms of risk profile. You know, on the one hand, you've got your core stabilized asset. You buy an office building, it's fully leased, it's generating income. You buy it, you're realizing return immediately through that income stream. On the other end of the risk spectrum would be, you know, maybe a new development. You're building an office building, and it takes a couple of years to build it, and it takes another year and a half to lease it up. And you're not generating return on that asset until it's fully stabilized, and that could be 3 to 4 or 5 years into a business plan. So there's a business plan aspect to J-curve, as well as the fee aspect that Keith was modeling in terms of the basis points, the 25 to 45 basis points. And that business plan J-curve is significant. That can add another 50 to 100 basis points of kind of drag on performance when a larger part of your portfolio, a bigger proportion of what you're invested in real estate, is going to be in that early stage business plan where you're not generating that return. And again, that's the type of thing that an investor that has a good liquidity profile can take advantage of. Others that need ongoing income to pay benefits necessarily can't. So you're in a position to take advantage of that for the higher returns that we would expect out of the non-core once those assets do stabilize and you're able to realize that profit.
At this point, I think we'll move over to 177, and I'll just wrap up real quickly with a summary. Because of the liquidity of our funds here at SIC, we can afford to take on well-compensated risk to bump up the expected returns of the portfolio. And so we're recommending changes that will enable us to do that. Specifically, the voting items are we'd like to move the ranges around the 60% non-core, 40% core target from the 30-60 mix on non-core to the 50 to 75 band, and the core from the former 40 to 70% range to the 25 to 50% range. And along with making that style shift in the portfolio, we think it's appropriate to adopt a modified benchmark. And again, we're recommending that benchmark be Odyssey plus 75 on a blended basis. With that, I'll pause and take any questions on things that we've talked about or some of the things we haven't.
So I would like to go to the definitions page just so to remind us what exactly we're talking about when we say or not.
That'd be 182, I think.
Could you just briefly?
Yeah, I'll take this one. So as I said, historically, when institutional investors started investing in real estate, you know, they bought large trophy assets. They bought shopping malls, they bought office buildings, large trophy assets that were stabilized and generating a lot of income. We call that type of investing core. And that was how institutional investors first started getting into real estate. And then over the years, investors and GPs, managers alike, started doing things to add a little bit of risk to the program to generate higher returns. So as you go from the core at the one end of the extreme, the other end of the extreme would be opportunistic investing, where you have properties that are broken that need to be fixed, you have new construction, maybe some overseas exposure, maybe to markets that are not as well developed as the United States. There are a variety of ways that investors would add risk to try to generate excess return out of real estate. And these definitions are all laid out on the page here on 182, but they're not necessarily written in stone either. There's a lot of gray area between these different categories. So for example, Core Plus is a newer sector that really evolved in the last 10 years. Value add is somewhat less than opportunistic investing, but you're still doing something at the property level to add value. You're not just holding the property to collect rents and watch it grow in value. So value add, you may have some kind of leasing risk. You've got a significant tenant that's vacating, and you know you've got to release 40% of the building or something like that during your holding period. And so as we look at the various categories of real estate, there are a variety of different things that you can do to add risk, and this chart tries to lay those out. It could be additional leverage, it could be going into niche property types, it could be going overseas, it could be taking more real estate risk, and it's a spectrum from that, kind of traditional core to the non-core opportunistic. Your portfolio is basically kind of called value add and opportunistic non-core, and you include core and core plus in your core portfolio, and so that's the divide that we're talking about today, and where are you emphasizing your investments in those two broader categories.
And so we're talking about going from 60-40 to the flip-flop of that?
Exactly. Exactly.
And there's no risk values that are related with these, there's basis point and return percentages, but...
Right. I guess,
in terms of quantitative, on this page, no, but things like the leverage level, if you look at that on page 182, you'll see the leverage level progressively gets higher. So, your equity is levered more, it's more at risk, and on the upside and the downside, you could have. So in real estate, we look at standard deviation of returns over time, but a lot of these quantitative measures aren't as good to capture the risk in real estate. What we like to look at really is, what am I doing to add risk to my portfolio? And it could be by property type, it could be by leverage, it could be mostly business plan type risk. What am I doing at the property level to add value?
if you look on page 165, the mean variance optimization that Anji ran kind of highlights what the change is in terms of risk. So if you look at the current mix row, you can express the returns there as 7.36% on an average basis, and then you would expect normally that you're going to wind up within plus or minus 7.25% on a one-year basis. If you move down to the proposed mix, mix B, you're seeing roughly a 40 basis point increase in expected returns, so 7.8%, and the width of that band goes from 7.25% to nearly 8%. So there's certainly a bit more volatility with respect to that mix than the prior one, but because the new dots are on that efficient frontier curve, what we're saying is it's well compensated risk, so you're not taking risk without a payoff.
So did you all have a discussion about this? Do you have a recommendation?
We did, yep. Yeah, and I mean, personally, and I think for the investment committee, I think the rationale around, not needing the income from core real estate, given all of our inflows, and therefore being able to move out the risk spectrum, just resonated with us.
Madam Chair, before you go to vote, I had a small front end to this presentation. I apologize, I should have spoken up. These asset class studies are really important. You use every we started doing them about 10 years ago. It was 2013, 2014, when we rolled our first one out. It was pretty rudimentary. Today we're quite sophisticated. But they're really critical because it's an expression on how our asset class directors feel that we should address these individual markets. They also give the council, as well as John and I, some expectation as to what we'll see in terms of the individual investments as they come through. And then to the strategy group, it's really important that we understand how, what will be in this portfolio, how it's constructed, how it will act, because it's a building block to the asset allocations that we bring all for approval. So really, really important stuff. So thanks for.
I guess my final questions are around, what did you say the timeframe for the structure study is? 4 years, 5 years?
We're looking at basically 4 years.
4 years.
Right.
And so what are the interim, how do we look at it?
So a lot of the ways we can track it is as the individual investments come through, we see those. We see it through the pacing model. Are we hitting the targets that they expect to hit? And then, of course, monitoring investment returns. Are we achieving the returns we thought?
We track in our performance reporting, we track every quarter. We put in a compliance matrix to make sure that the program remains in compliance with the guidelines. And that's why the requested changes here are not really, you're not changing your guidelines that much. The 60% non-core is currently within your existing guidelines. We're just asking for a little bit of buffer around that with the permissible ranges, because the valuations, it's hard to pin a private market valuation out in time. The benchmark is the most significant change here, and that's we put a lot of time and effort into that to try to figure out what's the right premium to your current benchmark, 75 basis points, given the risk that you're taking and the implementation of this over the next 4 to 5 years when you have that J-curve effect and other things going on in the portfolio.
So a fairly significant move in terms of what the benchmark looks like relative to history, right? We've just had a straight Odyssey benchmark before, with 40% of the portfolio being non-core. We've remedied that problem.
Further questions?
Madam Chair, based on the recommendations of the Council Investment Committee, Real Estate Consultant Townsend, SIC staff, and General Fiduciary Oversight from RBK, I move that the State Investment Council approve the updated structure study for the Council's real estate portfolio as presented to and discussed by the Council today.
We have a motion and a second. Any discussion on the motion before Council? Roll call vote on adoption of the structure study.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya. CFA Secretary Wayne Probst. Yes. Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Fred Summer.
Yes.
7 in the affirmative, motion passes.
Thank you. Okay, thank you.
All right, now we're going to move into the investment vote portion of our agenda. We've got 3 private equity investment votes. So we'll start with agenda item 4C. We'll call up Director Cassidy. Start with American Securities Partner 9.
Good morning, everyone. Middle market buyouts has been a focus this year. When you look at the underlying industry data, the middle market buyouts are over half of the buyout index. So it's an area that we've been focused on building out a portfolio over the last couple of years. We felt a little underweight there in the past. We're recommending in this investment a commitment of up to $100 million to American Securities Fund. As part of this, we're recommending a commitment of up to $100 million to a co-invest side, when we talked last year when we started the co-invest, started doing co-investments in the program, we started with, the Mercer SMA, and in addition to that, we contemplated setting up side-by-side vehicles with managers where it was possible. So this would be our fourth, side-by-side vehicle. We've done 3 others, but in special situations. Last month was Bridge Veritas. And as we build out the portfolio, the big ramp that Kurt has done, and talk about, this is a powerful way to put capital to work. It gets money, it gets capital in the ground in a very efficient way, and then we're not. So, do as many of these as we can where it makes sense. But also keeping the bar high in terms of
Chris, thanks, Madam Chair. We're presenting American Security Partners 9 today. This is a firm that was established in 1994, and of the 2 current co-leads of the firm, Michael Fish is a co-founder. David Horing has been with the firm since 1995, so the leadership team has a lot of longevity as well. They're supported by a sizable investment team and also a resources group as well that has 53 employees to support portfolio company value creation. Overall, across the investment and the resources group, they have about 94 employees. One item to point out from our report is that the firm originally came to market with a larger fund target, but due to the challenging fundraising environment, they lowered that fund target. As a result, they've made some changes. They've made their strategy more focused on the industries that they've had success in, and they've also had some team departures to reflect the smaller size. However, they continue to have continuity with the 4 investment committee members, and they continue to have a sizable team as well. So we view these changes as a positive for the firm. Most of their sourcing is through local networks or proprietary sourcing, and most importantly, the resources group really tends to be involved in the early stages of due diligence as they start to look at companies, all the way to post-investment where they're active in various value creation initiatives to make better companies from the companies that are owned by American Securities. From a track record perspective, they have funds going back in 1994. You can see in our report that 6 of the 8 prior funds rank in the first or second quartile against the buyout benchmark, with many funds around a 20% net IRR. From an alignment perspective, many of the fund terms are similar to what we see with other funds. They do have a strong general partner commitment to this fund, which is good from an alignment perspective. As Chris mentioned, we're recommending a $100 million commitment to the fund, and then a $100 million commitment to a side-by-side co-investment vehicle at a management fee, carried interest fee-free basis. I'll turn it over to American Securities.
Thank you. Good morning. Thanks for making time for us. I'm joined by Amy Harsh, who is the Managing Director and the head of our Investor Relations, and Jillian Detmer, who is a Director on our Investor Relations team as well. This morning, I'm going to do a quick introduction of myself. I'll tell you about the history and the values of American Securities, and then I'll try to describe how we'll seek to generate market-leading returns for you as investors and for return generations and future generations of stakeholders. So my name is Aaron Meng. I'm one of the investment managing directors at American Securities, and I've been with the firm for 10 years. I lead our activities in building products and the construction end market. I'll come back to that more in a little bit, along with my other roles in the executive and management committees in the organization. Prior to joining American Securities, I was at various venture roles, consulting, and I have an engineering background. I graduated from the University of Texas at Austin with an engineering degree prior to moving to the Northeast. At American Securities, we start all of our new partnerships and relationships talking about our mission and values. So in our business, everything that we do is around trust and relationships. And so when we come into a meeting like this, we always talk about our mission, and then we talk about our values. On the mission side, our mission is to generate superior returns for our investors, and to do that by buying strong businesses and making them even better. On the value side, we try to live up to this mission while also demonstrating our core values, which include things like teamwork, hard work, honesty, respect, and giving back. And, these core values are extremely important to us, and so we try to keep ourselves accountable by debating them from time to time, but also collecting information from our LPs, from our company, and making sure that we stay accountable to this mission and values, similar to the fact that you have a mission and values that you care deeply about as well. American Securities was started 30 years ago as a private equity firm, but the history actually goes back to a family office that went into the 1940s. That family office history is what our strategy is built around today. So we have two parts to that strategy. The first is around capital preservation. So when we invest in businesses, we are trying to buy very solid businesses that are in good end markets to reduce the amount of risk that we're taking. The second thing that we're trying to do is that we roll up our sleeves to our resources group to actually add value so that we leave the businesses better than how we found them. We've been able to do this because we have a very long tenured firm. We have very high retention in our organization. We're always trying to make sure we bring in new perspectives so that we're challenging the status quo. But at the same time, this has been able to help us navigate all the different market conditions that happen around us. And a lot of the team has been together for over 20, 30 years in that respect. So the how we take this strategy and actually apply it, again, is really two levers. The first is that we really focus on markets and we go deep into those sectors. So going back to my background, I spend my time in building products and construction, which means 100% of the time I'm working with my team members to map out the industry and understand every step of the value chain. That means manufacturing, distribution of products, services, in terms of how it's installed and maintained. We use those deep insights and relationships to figure out which companies we want to buy, when we want to buy them, and then have an action plan of what we're going to do with them post our investment. And I cover one subvertical in construction. My other partners lead subverticals similar to me, and they go into those markets in depth with deep relationships so that they can deliver that same kind of expertise. The second part of our value creation is the resources group. So while our investment team size is fairly large, we have a resources group that has over 50 people in it as well. And that resources group is a group of men and women who are focused on rolling up their sleeves and helping each of our portfolio companies. We have built them very carefully to be functionally oriented as opposed to general business managers. So they bring capabilities in areas like information services or technology, cybersecurity, supply chain, recruiting, and they are called on by our CEOs to be experts in those areas. Many times when we buy businesses, as you can imagine, they're busy dealing with problems for their customers or figuring out what suppliers to buy from. And we are working with them to try to accelerate growth and change the organization so that we can deliver returns for, partners like you, our investors. So we've been building this team for over 20 years, and they partner very closely with us on the investment team and our CEOs to deliver that value post-investment. To quickly demonstrate this, I'll talk about one company. We own a business today called Foundation Building Materials, which is the largest wallboard distributor in North America. And there, the CEO is a gentleman named Ruben Mendoza. And he partnered with us because he saw an opportunity to grow his business in e-commerce and online sales. We used our resources group and the team of people in that group, partner with his team, and take the business from having no sales in that space to over $300 million in 4 years. So we try to help bring capabilities so that they can accelerate their growth in various ways, depending on what the thesis is for the investment. And that comes from sector expertise and knowing which businesses to buy, and then what opportunities there are, and then applying that with our resources. That's kind of our strategy in a nutshell, is putting those three things together. So I went over the strategy and the culture, and all of these things have delivered strong returns for us over time, and we'll seek to continue to in the future. In addition to that, we've been recognized at various different industry awards over time. including things like GrowthCap, who named us a top private equity firm, and Prequin, who recognized us also as a top private equity firm, which was an interesting one because they have almost all the data on private equity, and they view us as one of the most consistent players in the space that we live in today. So that's a quick summary on us. And again, I thank you for giving me the opportunity to talk about our firm, our values, and how we try to differentiate. And I'm happy to open it up to questions, to answer anything that may be on your mind.
Council question.
Based on the recommendation of private equity consultant Mercer, SIC staff, and general fiduciary oversight from RBK, I move that the State Investment Council approve a commitment of up to $100 million to American Securities Partners from numeral 9 LP, and additional side-by-side co-investment commitment of up to $100 million, subject to and contingent upon Mexico legal requirements and the Mexico State Investment Council policies, negotiations, final terms and conditions, and completion of appropriate paperwork.
We've got a proper motion. Do we have a second? Second. Okay. Motion and a second. Any discussion on the motion? Roll call vote on this investment?
Commissioner Stephanie Garcia Richard,
Yes.
CFA Secretary Wayne Probst,
Yes.
Catherine Allen,
Yes.
John Bingaman,
I'm recused on this matter.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Rick Summer.
Yes.
6 in the affirmative, motion passes.
Thank you very much.
Next, we have 2 New Mexico private equity investment opportunities. We're going to go first to Builders VC Fund 3.
I'm going to make some high-level comments about the 2 investments we're proposing for the New Mexico program this month. Recommending, first, on the Builders VC side, a fund commitment of up to $65 million. The Builders Third Fund, they're an early-stage venture capital fund that targets companies driving the modernization of traditional industries, agriculture, healthcare, industrial technologies, and real assets. We're also recommending a fund commitment of up to $15 million Media Tech Ventures, which is an early-stage venture capital fund with a focus on the intersection of media and entertainment and technology. Both these firms are represent experienced managers that plan to have a New Mexico presence. In the case of Builders, they plan to open a Santa Fe office. In the case of SIC and Media Tech, both partners live in New Mexico. As we discussed last month with the Roadrunner and Frontier Fund reallocation, tech transferization and commercialization will remain at the core of the New Mexico program, and groups like that are looking to tackle that directly. But not all New Mexico businesses with the international scope have or will arise from technology developed at just universities and national labs. So, while we expect the core focus of the program to remain on deep tech, we
presenting a commitment to Builders Venture Capital Fund 3 for the New Mexico program. With recent commitments that you've seen us bring to this program, we're really emphasizing experienced teams and investors that can bring economic development possibilities to the state. I think this is a good one. Builders VC was founded by Jim Kim, who previously worked at Coastal Ventures and Formation 8, and has 20 years of investing and operating experience. He's joined by 5 other partners. In total, the 6 partners average 20 years of investment experience. Builders also has 9 operating partners who have unique experience in helping companies post-investment. The strategy focuses on early-stage venture capital investment that develop technologies that can help older industries, things like agriculture, industrials, healthcare, real assets. They source investments through their networks and utilize a scout network to really source investments in local geographies. Post-investment, Builders works with company CEOs, typically as board members, and it will leverage its operating partners to assist with things like sales, marketing, engineering, graphic design, team building, public relations, and back office support, which are valuable to these early-stage companies that don't really have those types of resources. Performance at the Builders, the firm, is still evolving with the value largely unrealized, but the absolute performance is attractive for the New Mexico program currently. Prior to Builders as well, the partners participated in many investments that generated favorable performance, including 5 with over a 10 times return, which is one of the attributes that we look for with early-stage investors. One thing we're excited about that they'll go into more detail about is the economic development possibilities in the state. They have a multi-phase plan that they're working on. They've done this in other states as well successfully, and they've already committed to a New Mexico investment, so they've already gotten started as well. So we're recommending an up to $65 million commitment to the fund, and I'll turn it over to Jim.
Thanks, guys. Pleasure to be here. Good morning. So Builders VC, as Chris and Richard mentioned, we are a venture capital firm that focuses on modernizing old world pen and paper industries. So you're thinking about agriculture, infrastructure, real assets. You know, these are sectors that over the past 10 years have not invested in technology. So there's a significant technology debt that has accumulated. And unfortunately, it's time to pay the piper, right? And it's for all the reasons that Vince mentioned earlier. These industries are now facing increases in commodity prices, labor shortages, significant regulatory hurdles as well. And so the only way these companies in these sectors are going to address these issues is to innovate, to adopt new technology, to innovate their way out of these issues. So let me give you an example. 3 months ago, I was on a livestock operation, a cow-calf operation outside of Tulare. And I sat down with the owner, and I asked him, well, how do you make your decision? How do you make your decision about how much you feed each individual animal? And he said, well, I just do things the way my dad did it. And he does things the way his dad did it. And great-grandfather before that made the decisions. And so that is how these industries operate. And then I asked, are you profitable? And the answer was no. I've actually lost money the past 4 years. And I'm about to lose the farm. And this is a common refrain for this industry, unfortunately. So I asked about long-term strategic planning. And the grower, he pulled out the 2024 Farmer's Almanac. I didn't even know that thing still existed, right? But that is their strategic planning mechanism. And so what does Builders do to address this problem? So we've invested in a company called Performance Livestock Analytics. And these are two founders out of Ames, Iowa, right? You don't solve cattle ranching from Stanford University. You solve it from Ames, Iowa. One grew up on a pig farm. The other grew up on a cattle ranch. And they basically built an operating system for cow operations. And so it takes into account how much is a cow eating? What are grain prices doing relative to hay? Oh, those 2 individual animals, they're not growing according to the growth model for that particular Black Angus steer. We are better off selling those 2 animals rather than continuing to bet on them.
It's Moneyball.
Yeah, exactly. It's Moneyball for cows, exactly. And now it's taken off like wildfire, right? There's a 1 in 4 chance that the hamburger you eat tonight is managed by a Builders portfolio company. Growers are using this technology 7 days a week, 5 hours a day. What else do we use 5 hours a day, right? It is sticky. It is addictive. It is what they use to run their operations. And the company is growing like wildfire without investing in customer acquisition. basically people refer each other to the software. And their cost of customer acquisition is 2 cases of Busch Light and a trucker hat, right? That's how they get new customers. That is a builders type company. So why are we here? Why are we in New Mexico? What's the opportunity? Well, when you look at the Venn diagram of what we invest in, old world sectors like real assets and agriculture, and you look at the New Mexico economy, there's a high degree of overlap, right? And therein lies the opportunity, because we don't believe that you solve issues from ivory towers. You solve issues by going to the centers of excellence and where the customers are, right? If you're going to solve cattle ranching, you're going to do it here. And that's the opportunity. So we have a number of portfolio companies who are very excited about moving to this geography and actually have filed their certificates of authority because their customer base is here. I'll give you another example. So not to belabor the agriculture point, but we have a company that is focused on livestock insurance. Did you know that only 3% of the cattle in North America are actually insured? So if I'm a grower and I have a bovine respiratory disease outbreak, I'm out of business, right? But this opportunity to actually provide cattle insurance to growers would be completely game-changing. They don't even think about risk, right? 60% of cattle ranchers have no idea how to hedge. So giving them the tools to educate them on risk management so that they could live through some type of disease or catastrophic outbreak would be totally game-changing for the industry. So we have a company that we spun out of a disease modeling company in San Francisco. Makes zero sense for this company to be in San Francisco, but they are providing cattle insurance, swine insurance, poultry insurance, right? And for them, their largest customers are here in New Mexico. Their second largest customers are in Arizona and Texas. It makes zero sense for this company to be located in California. And so they are moving here. They're setting up their headquarters here because they want to be close, right, to their customers. They want to be able to service their customers. It also happens that the insurance requirements, the capacity holding requirements, the amount of capital you need to have on your balance sheet to be able to issue an insurance policy is 2 times higher in California than it is here. It also happens to be in New Mexico. There are wonderful college programs in the insurance industry, and most of the financial services sector has an insurance background. So it just makes sense for this company to locate here. And that is where we see opportunity across our portfolio. I'll give you another example. We have a company called Amplifier Health, right? So there's been a lot of focus on generative AI and AI technology applied to healthcare. And there are going to be a whole host of companies that are just going to die, right? But there are a handful of companies that are really thinking about AI and the application of AI in a logical way. They've thought about it in terms of not just AI addressing healthcare, but more about what is the pain point we're addressing. So this particular company is focused on rural health, and the application is telemedicine. So when all of us go for a telemedicine visit, chances are the doctor gets on the telemedicine visit and says, all right, well, can't really tell everything over the phone. Why don't you come in for a test, right? And so the effectiveness of that telemedicine visit is minimal, especially when you have to travel 5 hours to get to the nearest lab to get a test to happen. And so this company, Amplifier Health, uses AI technology to actually analyze voice biomarkers. So if you are ill, if you have a cold or heart disease or diabetes, it turns out that your body changes and your vocal cords change. We don't know why this happens, but when you analyze the data set, your vocal cords, maybe they swell, or maybe because of certain indication, there's a slight tweak in the way you speak. And so this company actually went out and they acquired numerous data sets, starting out with the Florida State Penitentiary, out of all places, because people, when they make calls, all of those calls are actually recorded and are available for public information. And they've tied that back to changes in your vocal signature. And they can predict with 99.9% accuracy whether somebody has an opioid addiction, just by a 10-second snippet. Right? They're able to predict with 98% accuracy depression, right? And now they're working on Parkinson's disease because there's no non-invasive test for Parkinson's. So they're working with Sergey Brin, who's the founder of Google, and he has a biomarker for Parkinson's, and so he's been devoting resources to this problem alongside the Michael J. Fox Foundation. And we're also focused on pregnancy, right? So instead of the home pregnancy test, being able to speak 10-second signature, right, into your phone, and being able to identify, hey, you're pregnant at 4 weeks, is a very powerful application. And we know this is an entire new field of medicine that's being developed, and we know the Department of Health is going to be spending $2 billion looking into healthcare. And so it just so happens to turn out that New Mexico has a very strong interest in rural healthcare. And so we're talking with the ROAMS project, right? We're talking with Project ECHO, which are focused on telemedicine and diabetes and rural healthcare. This is a natural fit-in to partner alongside those programs to not only generate data, but also reach customers. They're talking to the Buck Institute, thanks to a couple of introductions, about partnering together to go after more indications and look at more data. So that company has also determined, hey, it is really hard to partner in the Bay Area with Stanford and UCSF. But here in New Mexico, with the rural healthcare application, it just makes complete sense. So they've also taken the approach of, hey, let's build an office here. Let's move our headquarters here. Let's really partner. Let's hire locally. This approach of bringing companies in to the states where the economy matches up with the problem, that's something Builders has been very successful doing. So as Richard mentioned, we've been doing this now for multiple funds with the state of Hawaii. So not only are we the state of Hawaii's best performing venture capital fund, we have created 129 high-tech jobs in Hawaii. We have brought 4 companies from the Bay Area and New York into Hawaii, and they've set up their headquarters. They've moved from New York City to Hawaii because that talent base and their customer base, it just makes more sense to be located there. And we're even more excited. If we could do that in Hawaii, out of all places, can you imagine what we do here?
Southwest.
Well, you actually have,
Hawaii is a little bit different than.
their economy is largely tourism and logistics. Here the overlap is even stronger, and that's why we're even more excited to partner here. And so we're grateful for the opportunity. We think we're not only going to provide you the best VC industry returns, we're going to create a vibrant technology ecosystem here that starts with bringing companies and talent in. And then as those talented individuals start to develop new companies of their own, we get to finance those. And I think that recipe is absolutely perfect for what Builders in New Mexico can do together.
So, Mr. Kim, I have 3,500 grazing lessees ready to hear the pitch from the analytics.
I'm very excited.
Member Allen, are you going to give your speech about the entrepreneur ecosystem, or you want to wait till the next presentation and give it to both?
I'll wait.
Question.
In the interest of disclosure, I know Greg, and done work for, not him, but for his wife's family over the years. I just want people to know that. I know nothing about this company, and I've never spoken to this company. Back to you.
So what is your role?
So I'm based here in Santa Fe. I've lived here for 6 years. I've been in the private equity and venture space since 1995. I actually helped run one of Jim's portfolio companies called 280 Earth. And so I think when I was actually looking at opportunities in New Mexico for 280 Earth, which is based in Palo Alto, working with Land on Sandia, and I started telling the story about moving 280 Earth to New Mexico. Jim said, that's what we do, Greg. Jim's on our board. We're on a board together. So I started to describe to him what was going on in New Mexico, and he started describing Amplifier. Actually, on Amplifier, the first thing I asked him, is it agnostic to language? Does it work on Spanish, Navajo? Can this apply in the rural areas of New Mexico? He said, absolutely. And so I'm going to be the lead here in New Mexico, helping these portfolio companies come here. I think it was exciting to me to hear Jim's focus on bringing head companies to New Mexico as opposed to doing tech transfer out of the labs. That is very difficult. And I've been coming here for 40 years. My wife's family's been here for over 100 years. So I have a little bit of a sense how to do business and how to execute here.
Sounds exciting.
Excited to be here, excited to partner with you all and please feel free to reach out. I'm excited to speak to all of the cattle industry folks that you have.
Madam Chair, based on the recommendations of the Council Investment Committee, Private Equity Consultant Mercer, SIC staff, and the General Fiduciary Oversight from RBK, I move that the State Investment Council approve a commitment of up to $60 million to Builders VC Fund 3 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, and negotiation of final terms and conditions, and completion of appropriate paperwork.
Okay, we've got a motion and a second. Discussion on the motion? And then we'll take a roll call vote.
Commissioner Stephanie Garcia Richard.
Yes.
Catherine Allen.
Yes.
DFA Secretary Wayne Probst.
Yes.
Kelly O'Donnell.
Yes.
Don Bingaman.
Yes.
Alan Sanchez.
Yes.
Kurt Summer.
To avoid the occurrence of any impropriety, I just want to.
That's 6 in the affirmative. Motion passes.
Very good, thank you all.
Thank you.
Thank you very much.
All right, next we're gonna move to, TK Media Tech Ventures. Hopefully you all have a story that's as good as, your voice being able to diagnose the
Yes, we do.
And second,
It doesn't involve any talent.
Yeah, we're a little light on the camera department.
This is all music to my ears.
The scary one is like people that are speculating we should speak with our animals in the next 5 years. Can you imagine it?
I already speak with my elves. What are you talking about?
So, continuing with the theme of adding experienced investors to the program, we have an opportunity to support a new New Mexico-based fund that's operated by 2 New Mexico residents who previously operated a venture capital fund. TK Media was founded by Stuart Alsup and Jim Ward. Both previously worked together at Alsup Louis Partners, which is not raising another fund and just winding down the current portfolio. I'll give a high-level background, but I mean, they have a really deep background, so it's not going to do it justice. Stuart Alsup started as a journalist and commentator in the tech industry before joining a well-known venture capital firm called NEA in 1996, then founded Alsup Louis Partners. Jim Ward has operating experience in the media industry, having served as president of LucasArts and senior vice president of Lucasfilm. Alsup Louis invested in Santa Fe-based Meow Wolf, which has expanded to multiple locations nationally, and Jim Ward was co-CEO of Meow Wolf for a time as well. And the 2 of them plan to add a 3rd member to the team once the fund is raised, but right now it's just the 2 of them. And this firm is focused on the technology investments that target the media and entertainment industry, which is consistent with their previous experience. The strategy focuses on assisting with company formation around these technologies, and their team is expected to provide advice to the management teams post-investment around strategy, team building, and how to get additional financing. Since this is a first-time fund, TK itself does not have a prior track record, but the 2 managing members do have track records at their previous firms. And we looked at the previous investments at Alsup Louis that were in this space. There was 18 of them. And they've generated a gross IRR of over 35% and a gross multiple greater than 3.5x, with 3 of them being above a 10x. And so these investments have performed. The fund's terms are typical of what we see with other venture capital firms overall, and you've heard from a state perspective, the 2 managing members are based in New Mexico and plan to be active in the local venture capital ecosystem. We're recommending an up to $15 million recommendation to the commitment to the fund. I'll turn it over to Stuart and Jim.
Richard, Chris, thank you very much, Madam Chair, and members of the State Investment Council. We really appreciate the opportunity to come and talk to you about what we're up to. I'm going to talk about us, and then Jim's going to talk about what we're doing. We're 2 media guys who moved to New Mexico, not to start a venture capital firm, but for other reasons, and then realized that here we are in New Mexico, and we know and understand venture capital, early stage venture capital. And because we're both media guys, we think that there is a significant opportunity to invest in technology
that will enable the next generation of media. So, as Richard outlined, I've had a career that is defined by media. I started as a journalist and spent 20 years covering primarily the technology industry, computer industry. And then I became a venture capitalist in 1996 with New Enterprise Associates. And over time, noticed that my best investing has been in technologies related to media. Companies like Sonos, Evo, Twitch, early in our firm, and others. So I started coming to Santa Fe in the 1990s. I have two brothers. Two of my four brothers have moved here. And so I bought a property here in 2001, 23 years ago. And so I have gotten to know Santa Fe. And along the way, I ran into this little company called Meow Wolf in 2015. And my personal experience was I went into the House of Eternal Return when it was under construction. Has anybody not been to the House of Eternal Return? Should we do a poll here? And I went into it when it was under construction, and it blew my mind. So I made personal investments in Meow Wolf that enabled it to open the House of Eternal Return, provided counseling to the company to convert into a corporation, a shareholding corporation, to form a board of directors, and started working with the team there. And then the house opened, and I'm sure everybody knows that the moment the house opened, the lines went around the block, and it was a phenomenal success. So over time, I engaged my partner at Allsop Louis, Jim Ward, to evaluate Meow Wolf as a business before our firm, Allsop Louis Partners, made an investment in the company as a firm. So we asked Jim, once we'd made the investment, to help the CEO, Vince Castlebeck, the founding CEO, to grow the business. And that led directly, once Vince stepped down as CEO of the company, for Jim to be a member of the office of the CEO at Meow Wolf. And that's kind of who we are, as two media guys, by happenstance, happen to be here in New Mexico, and we believe that there's an opportunity for us to establish a new venture fund here that will invest in technology companies enabling the next generation of media consumption.
Yeah, thank you. Well, thank you for allowing us to be here today. We're excited. Let me tell you a little bit about myself. I started off originally in the world of advertising, running global advertising accounts. I ran the global Apple business, introduced the original PowerBook. Ran the global Microsoft business, introduced Windows 95 with the Rolling Stones and Start Me Up, for those of you that remember that far back. Ran the global Nike business, introduced a young man in the world named Tiger Woods. But then I spent over a decade with a guy named George Lucas at Lucasfilm at a time when George was going to self-finance the next round of Star Wars movies, which became known as the prequels. And in addition to building the infrastructure for him to do that, we were on the leading edge of a lot of technological change in the media and entertainment business, from the first digital capture motion picture camera to digital transfers to IMAX to digital projection in movie theaters to investments in technology that radically changed the video game industry and ultimately won some Oscars for Industrial Light and Magic. When I retired from Lucasfilm, I joined Allsop Louis and became somewhat of an expert of dropping into companies and help them scale. And as Stuart mentioned, a company very near and dear to my heart was Meow Wolf, and I spent over 5 years over here helping that company scale. And we're very excited. Next month, we're going to be opening another installation in Houston and get Meow Wolf well on its way to becoming what the New York Times said the next Disney. We're proud of having done that. But we learned a lot along the way. And the reason we're very excited for all of us here today and for the state of New Mexico is we're staring down what we call the next convergence of technology in media and entertainment. There's a history about the first two. We've distributed that in our materials. I won't walk you through that. But this third convergence of technology, we actually call a reality disturbance. Because for the first time in history, first time in history, we as humans are going to experience a disturbance in our reality. With all of the emerging technologies that you've heard about, AI, XR, VR, all of that, are going to create these virtual worlds, which you've also heard about, the multiverse, the ultiverse, whatever they end up being called. And particularly in media and entertainment, these are going to be critical. But here's the thing. We are sentient human beings. And frankly, none of us want to live 24/7 in these Ready Player One worlds, okay? So an abundance of technologies are going to emerge that bridge these virtual worlds with our physical reality. And that presents a huge opportunity from an investment perspective in a number of different areas. And we outlined them in our materials, from generative AI avatars that pass the Turing test that can help you in new and amazing ways in gaming. The instantaneous transfer of physical currency into digital currency in the gaming world. The ability to use technologies to lower production costs in the ever-increasing digital world of production. The ability and necessity for companies even like a Meow Wolf, who started off as a physical immersive entertainment experience, and you actually are physically there, to leverage technologies to increase that experience within the four walls, but allow you to take that experience outside of the four walls. So these are a number of areas that we feel are going to be very productive. But here's the one thing I learned working for George Lucas for 11 years. Investing in technology, particularly in media and entertainment, for technology's sake is very seldom successful. Technology needs to service the creative art of narrative storytelling. And this is where New Mexico comes in. Because as Stuart and I travel around the United States and frankly the world, very seldom do we see the nexus of what we call creative vortices that exist in this state of New Mexico. And we call one of them called Meow Wolf. I'm the chairman of the board of Opera Southwest. I'm on the board of the National Hispanic Cultural Center Foundation. I'm on the board of the National Institute of Flamenco. I see the creativity in this state every day and have never in my career been as excited about this level of creativity that is made of an alchemy of cultures mingling together that is unique only to the state of New Mexico. And we know where these creative vortices exist. The emerging technologies that can support that and uplift that is a huge opportunity. And the state of New Mexico has an opportunity to do a couple of things. One, leverage its existing investment in the old model of traditional film production and TV production, the things that are already going on here in the state, but also capitalize on this new third convergence of technologies that will help us to not only invest in the state of New Mexico, but similar to what Builders Fund was saying, bring companies into the state of New Mexico so that we can help nurture and cultivate the next generation of a creative workforce to attract and retain the kind of manpower that we need in this state to catapult this state into the level of the Vancouvers and the Montreals and the Atlanta Georges and, dare I say, Hollywood. So we're very excited about the opportunity here and would welcome any questions that you have.
Total rate. We're targeting 75 million. So the commitment that the staff is asking for is 20% of what we're targeting.
Don't reach your target?
There's always this, so I've been involved in raising now 7 venture capital funds between NEA and Allsop Louis. There's always a process, particularly with a new fund, of going into the fundraising process. I think it was acknowledged earlier that the last couple of years have been a very difficult time to raise funds. So we have asked for the commitment from SIC to enable us to go out into the market and raise funds. At any level of commitment, you have to treat your level of commitment as the full fund. So if we get to 40 million, it'll be a $40 million fund. If we get to 75, but we know how to manage a fund based on the total commitment.
We've got a comment from Member Allen. Member Allen.
Okay, I'm sorry, it's hard to hear you, sorry. First of all, I'm impressed with what you are thinking about doing and already doing with Meow Wolf. I sit on the Museum Foundation board, and the museums are putting into their strategic plans also using these new technologies, AI and generative AI and so forth, virtual reality. I just think there's an opportunity, not just with the creative, artistic, for-profit entities, but also the nonprofits in the state. So could you speak to that? Have you worked with any nonprofit museums, or have you invested in anything that has worked with them?
Yeah, I just, in fact, finished a project with the George O'Keeffe Museum board and staff first a strategic project to ground them in their development moving forward as they're building, obviously, the new facility, but also what to do with the old facility. And for that old facility, their going-in proposition was, we want to Meow Wolfize it for a younger audience. But through those discussions, exactly to your point, the conversation became, how do we begin to leverage technology platforms in order to attract those younger audiences, but do it in a way that's been much more effective than potentially some of the flat-footed ways that museums have done that traditionally. What we look for from an investment perspective in technologies, particularly, are those technologies that can define a platform that can then be either licensed out or utilized by different organizations. And there's no reason nonprofits can't factor in to the utilization of these platforms. In fact, platforms that will serve the next generation of storytelling for immersive exhibitions like Meow Wolf, those platforms could easily be translated to nonprofit organizations like museums as well, which creates incremental revenue streams for us.
Thank you.
Chair, one question, just, and apologies, somewhat parochial question, but would there be any connection you would envision between this fund and Meow Wolf? Or, I mean, I know you had invested in a legacy fund, Meow Wolf, but and the reason I asked, I think a number of members in the council, certainly I had, they had hundreds of investors in Santa Fe. I was one of them, so just want to understand if there's any potential conflict there.
You got in before I did, but,
well, redeemed some of my stake as well, unfortunately, back in
the majority owner in Meow Wolf has set a policy of not revealing our results, even to current investors. But it is a firm, as a company, has over $200 million of revenue and over 1,200 employees. So the investment prospects for investing in Meow Wolf at this point are pretty limited because it is profitable and is growing rapidly. So the thing I would mention is one of the founders of Meow Wolf is seeking to start a new company called Submersive. It is public now, so we can say this. Not publicly held, but publicly known. And so we are in conversations with that person, Corvus Brinkerhoff, about becoming an investor in his new company. So we have an opportunity to participate. It will be from spin-outs of Meow Wolf.
Bringing up the multiverse put you on par with the Amplify being able to diagnose. Diagnose pregnancy from 10 seconds. That's what
that's pretty cool, I have to say. But if you're a gamer, I can get into a lot of cool gaming stuff if you're a gamer. But
I mean, I live with a bunch of gamers.
Okay. All right.
I have to say I was not a fan of episodes 1 through 3, so.
Well, please don't hold Jar Jar Binks against me. My boss had different feelings around that, and we had to do a lot to dance around some of those issues. But I will say, from George's perspective, whether creatively you appreciate it or not, financially they were a great success for Lucasfilm and increased the value so George could sail away and sell to Disney at a pretty nice premium. So.
Chair, based on the recommendation of the Council Investment Committee, Private Equity Consultant Mercer, SIC staff, and General Fiduciary Oversight from RBK, I move that the State Investment Council approve a commitment of up to $15 million to TK Media Tech Ventures LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Have a motion and a second. Discussion. Roll call vote on the motion.
Commissioner Stephanie Garcia Richard.
Yes.
CFA Secretary Wayne Probst.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Chloe O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Sommer.
Yes.
7 in the affirmative, motion passes.
Good luck to you all.
Thank you very much.
Appreciate it.
I think that I have this feeling, I don't know why, but that when we're in our old folks' homes and the world has changed beyond recognition from what it is now, we're gonna remember the day that we gave 15 million.
Let's hope so. We look forward to virtual, in your headset, SIC meetings.
All right, with that, we're going to agenda item 5, which is our governance matters. We're going to hear from the chair of the governance committee, Member Allen.
Thank you very much, Madam Chair. During our September 16th meeting, the committee reviewed the red line version of the investment policy statement. It's important that everyone is fully involved in the process, and that has been the case. The CIO will make revisions based on feedback from the committee and the council members. Further discussion will take place on our October 17th meeting, and no vote will be taken until after that. We also asked the Madam Treasurer, to provide any other lists of concerns. She gave some great feedback during the session. And also, John Clark will provide a list of council members' educational interests, which will also be included in how we go forward with the investment policy statement. That's all I have to report.
Questions for Member Allen?
I don't have any questions for Member Allen, Madam Chair, but I do have questions for Bingham and his committee. You had an opportunity to look at this. Did you have any concerns, any thoughts while we work our way through this? Welcome here. Feedback, Frank.
Yeah, Madam Chair, Member Summer. Yeah, we reviewed the materials. We made some suggestions that I see were reflected in the materials. The one suggestion that I felt most strongly about that I see in here is that if we do move to this new framework, we adopt a very firm policy that council members would not recommend investments or to refer managers to staff, because if staff is then choosing managers directly and reporting after the fact, I think we would all want to make sure that none of those recommendations are coming from the council. Not worried about the council today, but 30 years from now, with an entirely new group of people, we just want to make sure that is added to our code of conduct and fully understood. But I think with that, I certainly am comfortable with the recommendation, and also had the opportunity, as I know you did, to listen to the presentation by Fiduciary Council, which I thought was well done, and expressed, I think, some of the concerns with the existing framework that we have.
Thank you, Madam.
And Madam Chair, if it's okay with you, I'd like to proceed to the presentation of the slides that I covered with both the committees, starting on page, if we could go to page 356 of the diligent materials. And as noted, we really received great feedback in both committees. Both committees were presented with the slides as you see before you, except we have made a few changes already to the slides based on that feedback, as Member Bingaman noted. They were also supplied with the full draft investment policy statement. We did not include that in your materials today because we were already providing you with the policy statement with the technical changes. We have two completely different policy statements in front of you. So we're going to go back to both committees in October. We're feedback that you want to provide in the coming days. We're going to be updating the draft, go back to both committees, and then I will be presenting updated slides and providing you with a full policy statement draft at the next council meeting, so that you can take a look at any of the individual language that accompanies this if you want. What I have tried to do in these slides is to capture all of the ideas that are present in the policy statement. And I want to make it clear that although the policy statement draft was drawn up by staff, the ideas in it and the ideas presented here are very much a combined effort. I've received a lot of great input from the governance committee over the months that we've been working on this, from the investment committee the other day, as well as from other council members. A lot of great ideas from the internal team, and then also feedback from multiple national experts. So just want to mention this is really a reflection of a lot of input from a variety of people, and I want to thank everyone who's provided their feedback. If we could go to the next slide on 357. So as you all know, in 2010, SIC was restructured, made a lot of changes. One of the changes made at that point was for the council to start reviewing and approving all commitments. That has not previously been the case. As you know, assets under management at that point were about $15 billion, and now, as I mentioned earlier today, we just crossed $58 billion. The number of investments that have been presented each month has also increased dramatically over time, and now we're often asking the council members to review and approve anywhere from 6 to 10 investments in a given month, over 700 pages of material. And so the situation is very different now than it was back in 2010 when the decision was made for the council to review and approve individual investments. From the feedback that we've received from national experts, it's clear that it is a best practice for the council to ensure that there are appropriate processes in place, appropriate guardrails, and then to keep a close eye on all of the back-end results, as well as the performance data, also risk data and asset allocation, the selection of advisors and consultants, things like that. That seems clear to be a best practice for the industry. This proposal before you would leave essentially everything in place with what the council does currently, except for taking the final approval of an individual investment and placing it within the internal team. All of the other functions of the council would remain in place, and there's a proposal for the council to dive deeper into some other functions that it currently either hasn't taken on or is taken on to a much more limited extent. We can go to the next slide. So, in working with the governance committee, the committee asked that we retain expert fiduciary counsel that works with other sovereign wealth funds, as well as some of the largest pension funds in the country. And they asked a number of questions. So, Brent, we're on page 358.
Right.
In responding to the questions from the governance committee, I included some quotes here. You can read in your packets. This first quote boils down to, there's no bright line between exactly what a board or council should be doing and what staff should be doing. But in general, most high-performing organizations of our type have delegated the function of selection of investment managers, selection of individual investments to the internal team. And so they note that could be considered a best practice for the industry when you look at what the best performing organizations do. Going on to the next slide, the question was asked, we know that both council members and the internal team are fiduciaries. That's not going to change under any proposal, but beyond a fiduciary authority for the council to review and approve these investments, is there a fiduciary requirement? Is there a duty to do this? Or is it legal, and is there full legal authority, including fiduciary authority, to grant this authority to the internal team? And the conclusion is yes, there is full legal authority, including fiduciary authority, to grant this to the team. The council does not have to do it. It's a may, not a shall. The external fiduciary council then went on to review our internal team makeup and make sure that they felt like we had the people in place in order to do this. This goes back, I think, the question Member Sommer referred to earlier, do you have enough people on your team? We certainly could use more people, but we are getting the job done today, and you see recommendations that come before you on a monthly basis. This wouldn't change from our team's perspective the decision-making process that we go through. What you will see in some later slides is that we're making some changes to formalize the process because council members, I think, very rightly asked that we have clear processes and procedures in place. If we go to the next slide. A question was asked by the governance committee, could we just do a consent agenda rather than going through each item individually? And the fiduciary council said, no, we don't think that is a good idea because there is so much due diligence involved with this. Giving it a cursory glance on the consent agenda doesn't seem to be upholding your fiduciary responsibility, so they don't recommend that. Then the final question asked by the governance committee was, can we turn over the final decision-making to the investment? Can they be the place where this resides? And the answer came back no. So the investment committee does not exist in statute. It's a creation of this body. We have a charter for it, as we have for our other committees, but it is not a legal entity recognized in statute, and therefore there's no ability for the council to turn over any final decision-making responsibility from the body as a whole to a portion. So then going into the next slide on page 361. So here's the decision authority that the council currently has, and all of this would remain in place except for, again, the final decisions on individual investments. We would still set long-term asset allocation targets. We would still approve the consultants that work with our teams to select the managers. I think that's critical, and that was noted by fiduciary council as something that the council should still be heavily involved in and have final say in. We would still be approving our custodian. We would still be approving our asset class structures like you did earlier today with real estate structures. And you would still be approving our annual investment plans, again, as you did earlier. Then moving on to slide, the next slide on page 362. What's new? What's the new authority for the council? What's additional reporting that you and the public are going to get? Because I'm determined at the end of this that we can all honestly say this has improved public transparency and accountability. So the first is, in addition to setting the long-term asset allocation targets, the council would also be involved in setting annual interim asset allocation targets. There are a variety of reasons why we can't immediately jump to the long-term targets, both from pacing issues as well as current market conditions. This gives the council an opportunity to go in and have a discussion about those once a year, which currently doesn't happen. Currently, we're only setting those long-term targets. Second, you would receive annual reports on management fees. I'm about to start working with a consultant that we have that looks at management fees, and this has been a question raised by a number of council members wanting to take a look at the issue of management fees. Are we getting higher net returns as a result of the managers being selected? How are we doing compared to our peers? So I'm going to be working with this consultant to try to take a lot of data that they have and provide it in a format that's useful to us internally, but also to you as a council to make decisions based off of that data. Also, we're going to be taking another look at how we report performance. And here, more than anything, I'm thinking about our website. I think the members of this council are well versed enough in this industry to understand a lot of the performance data that we report to you, but members of the public are not. And to a member of the public trying to see who we are, what we're doing, how we're using these state funds, what they're getting for it as members of the state is really difficult. So this is a two-part issue. One part is that we're going to be bringing on someone to manage the website and working with the contractor to redo it from scratch. And part of that is going to have a dashboard on the main page where my goal is for anyone who has heard about the SIC, heard about the impact that we're having, or just heard that we have $58 billion of state money, that in 2 or 3 minutes they'll be able to take a look at this dashboard and see where the money is going, how it's being used, and most importantly, what the returns are and what the impact of the state is. Because right now, any member of the public has to sort through hundreds of pages of information on our website. If we go to the next slide. So I was asked to look looked at what are the existing safeguards and guardrails and then what would be new. So for the existing safeguards, asset class directors and the consultants, again, the consultants that you have final say in hiring, perform a significant due diligence and come to a determination if either the asset class director or the consultant doesn't feel like we can proceed with an investment, it stops there. Then I can essentially stop any investment at that part of the process before it comes to the council. There are also then, after the council makes its decision, legal review and negotiations that are required. These often take months, and they don't always result in final implementation of an improved investment. All of the language that used to approve investment is contingent on sufficient legal consideration, and there are occasional circumstances where we are simply not able to negotiate a contract that we feel upholds our fiduciary responsibility or gets us the deal that we thought we were getting in the first place. That would all still stay in place. There are also restrictions on percent of assets that can be held by a single manager. There are restrictions against investments directly into companies, and there are additional restrictions that exist in the asset class studies that you all approved. Now, what would be new on the next page? There's the language formalizes and expands on current procedures in place to say this is how we're going to do it. So now it says the consultant and the asset class director need to both recommend something for it to move forward. There's then an internal review by full-time professional peers. The new risk and performance officer position that Nino has will take a look at investments from a risk perspective. And then now this new draft policy statement explicitly gives both the CIO and SIO veto authority so that both of us have to think this is a good investment or it doesn't move forward. And then finally, there's still the legal review that needs to be. Again, I discussed the risk and performance officer position earlier. Due diligence protocols are now in place because council members have to see how are we selecting our managers. So that's now discussed in the document. And then additionally, to improve transparency, we would now present to the investment committee a line item listing of all investments held by the funds. And there was discussion at the investment committee meeting of still providing all of the materials to the investment committee as well. So they get a listing of everything that we're investing in. They get all of the presentation materials so that if the investment committee members have a concern or question about anything, they can raise it, and there's still that additional layer of review, even though it wouldn't be an approval process. And then finally, the last item on here is what Member Bingaman mentioned, that to prevent even the appearance of a conflict of interest, council members would not be able to make private recommendations to the internal team for investments. If a council member feels strongly about a particular investment or type of investment, they could do so, but only in a full SIC. So that there's full transparency. And going to the final slide here, changes to the investment committee activity. So what would the investment committee do? The investment committee already spends a lot of its time dealing with issues other than just individual investments. So everything else would still go to them. If we're hiring new consultants or making changes to what our consultants are doing, that would go through them. RFPs go there, performance reports, asset class studies, everything like that. And then in addition, the additional information I just mentioned about the line items and presentation materials related to it. But also now, the committee would take on a larger role in terms of diving into management fees, where to some extent we need to be able to have those in a less public situation for some of the data that we're going to be diving into. And in addition, there are a lot of considerations that go that are tied up with the pacing model, and again, how that pacing model feeds into decisions related to the annual interim asset allocation. And so the investment committee could really start diving into that pacing model to understand everything that goes into that, and then help guide the decisions related to this interim asset allocation. And then I'm proposing that if this were adopted, that we would have an investment committee meeting in early 2025 focused exclusively on management fees, because it is going to take probably a few hours to go through that information and have that. And with that, Madam Chair, I'm happy to answer any questions. Again, this is going to be brought back to both the governance and investment committees next month, again, for discussion purposes only, not a vote at that point, and then I'll bring back updated slides and an updated full draft policy for the council to review next month, and just for discussion, not for a vote.
So under this new framework, what if there's a problem? How does a member raise, like, I have a concern about X? How does that happen?
So, Madam Chair, again, all of the materials that are currently presented, the investment committee would still get, so if they have any concerns, they can raise that at the time. But also, we're going to be providing that line item listing of everything that we're invested into to the full council as well. So if you see something that is concerning, please raise it at a council meeting, raise it at a committee meeting, raise it to me or event, and we'll address it.
Madam Chair, I think it's also fair to say the full council then has access to each of the committee materials, so I think the full council will continue to have access to the materials related to each investment.
Will the performance reports change? Because
the performance reports, I think, will be enhanced. You're still going to get everything that you're currently getting, but Nino and I are going to be working to take a look at are there best practices in terms of how organizations like ours report performance as well as report risk. So we're taking a look at how some of these other organizations report it. So we might add on to the performance reporting that you currently get, but we're not going to get rid of anything.
how does ERB and Terra do it? Do they vote on each of their investments?
Madam Chair, ERA was the first Mexico fund to take the board out of the selection of individual managers. I think that was 4, maybe 5 years or so ago. ERB followed years later. So individual investment decisions no longer made by those boards, by staff.
Madam Chair, I think it provides more time for oversight that we don't have today, without having to pick each investment. It's an opportunity to look at the big picture and see what returns look like, what risk is looking like, whether we're meeting our objectives.
Anything more?
Madam Chair, again, if any member has any comments or suggestions, I'm trying to incorporate feedback moving forward to the next iteration for the. So if any of you have anything you want to follow up with me on, please do.
Mm-hmm. So, Madam Chair, I just want to thank you. I just want to compliment John and the staff on the process we're using. We're trying to be transparent. We're trying to be inclusive, trying to have robust discussions as we have had, particularly at the governance committee meetings. And I want to call out on Treasurer Montoya, who's brought up a number of important issues that we keep addressing. That's why it keeps changing. And again, trying to focus on best practices from using expert opinions and outside perspectives. I always think of the end game and where we end up, and can we say we've gone through the best process to the citizens of New Mexico, and then when we explain whatever changes we're recommending, that they have had an opportunity to see our process and to weigh in if they want to. So I again, congratulate John and his team on doing that.
Okay, so we're going to move on from this and hear from our CFO.
Madam Chair, 2 minutes. That's all I'll need. I just wanted to mention, and I think I had brought this up in an earlier meeting, we are going to be doing a bar probably within the next 1 to 2 months. Initially, I thought the bar was just going to be for the unfunded, 6 positions, that we need to get funding for. I went through and evaluated, some of the, POs that we currently have, purchase orders related to our public mandates, and, decided, probably need to, do a bar related to the management fees as well. And you might say, well, why is that? Probably the biggest reason is we didn't factor the magnitude of the inflows that we have. We thought we had a pretty good feel, and the other probably more important point is we couldn't anticipate any new funds that the legislature would be setting up. So there's additional dollars that we have related to those assets. So we'll be doing that bar over the next 60 days. And then lastly, I just wanted to let everybody know, as we approach the end of September, it's kind of the cutoff for getting the marks in for our private investments. It's usually 90 days after the quarter ends. So to actually get the June results, it takes us all the way through September. So our audit will be ramping up over the next few weeks. We're not anticipating any problems at this point in time, and that's all I had unless there's questions.
Questions for Frank? We'll go to agenda item 7A, any old or new business before the council. Okay, our next SIC meeting will be Tuesday, October 29th, I believe, right here in this room. Mr. Woolman, on item 8, do we have anyone to give public comment before this?
We do not, Madam Chair.
Okay, and with that, do we have any objection to adjournment? None, we are adjourned.
That they are spending their $4.5% government tax bond on non-capital, down payment assistance, debt financing, a bunch of different things. And I'm trying to figure out what the